addressed the risk that this control is not in place effectively. It's not implemented correctly. So again, these are forms within the template. Obviously, you can utilize other options. I'm just going to show you the last option here, which is also another, it's more of a horizontal format. And so let me pull that up here.
And these last two forms are interchangeable. You would use one or the other, or if you're using just a Word document, you might just do it in Word. But it's either memo form or tabular form. I see it about 50-50. It really is personal preference in what teams like to use there.
So again, this is that tabular form that Sean is talking about. So going through the procedures, the documentation, the walkthrough process, who performs that control, the exceptions, and any inquiries or comments that we may have. Again, it's going to be one or the other. You're really not going to be utilizing both, but I wanted to make sure that you saw the options. Any questions on any of these forms? I know we went through them relatively quickly. Just wanted to make sure that we had an opportunity to see them.
Fabe, on that last form, last two forms, the walkthrough forms, there's going to be a column or a section that says walkthrough procedures. And we want to make sure that we're doing something, we're doing enough such that we can look at our boss in the eye and say, I know they're doing this control, whether it's inquiry, inspection, reperformance, observation. And I know they're doing this control. And the phrase that Fabi used before lunch break was, and what they're doing would catch a material misstatement or catch a big mistake. So this is such a critical area, and I'm kind of going to use this as we dovetail into the next section, because if we make a bad judgment here, if we say they have controls in place, they're D&I designed appropriately, and they are implemented, we've seen them once, and we make a bad judgment, when we get to the end of the audit, which we'll cover in part 4, and we start finding errors, anytime we have an error, we should evaluate whether that error is indicative of a lack of control or a control that exists, but they're not doing it right. In other words, why would a mistake happen? So we don't want to get burned later, which theoretically could happen. How do you explain that you have 15 entries at the end of the audit when you concluded through this work that they've got great controls? Well, if they had great controls, they wouldn't have all these errors, because controls are set up to catch the big mistakes. And the only other thought I have, Fabian, and you can finish up with your thoughts on this section, is the first form that she showed, which was the 4.2.1. You're going to have a separate one of those for payroll and cash and purchasing and all that stuff. That's where some firms like to just keep it in Word. Other firms in the period of transition, like the year they moved to Checkpoint Engage, for instance, they may take their narratives and copy paste and say, okay, we're going to drop it in here. And, it rolls forward. So you're not wasting any time in the future. It's going to be in those forms, and those forms are going to roll forward. If deep down your firm's preference or your team's preference is, I just want to keep it in Word, that's fine. But you've got to make sure you do the things that are on this slide right here, these best practices. And you still, at the bottom of that form, and all the control forms in PPC, there's a question that says, I don't know it exactly, but I'm close. Considering the size and complexity of the entity, are the control procedures properly designed and implemented? We always check yes. If we're not using the form, we've got to make sure somewhere we're making that conclusion, because that tells us that the client will catch a big mistake. And then when Fabe and I go through part 4 and we talk about your 12.2 form and your adjusting journal entries, we'll loop back with, hey, is this an issue because of we made a bad control conclusion last week, last month, maybe 2 months ago, when we were auditing in the top half of the hourglass. And I see that a lot with firms. They say, oh, the client has great controls. Then they have 20 entries. Something doesn't click. something's off. And we've all lived it. Fabe and I have both had those kinds of clients, right?
Absolutely.
You can't rely on wishful thinking in the top half of the hourglass. Maybe that's the simplest way I could have said it for all involved and been done quicker.
Absolutely. And I would say Sean kind of talked about this, and it's included in our best practices here, but we have to do more than just inquire. So when we go through that walkthrough process, we have to rely on some of those other evidence gathering methods to make sure that implementation is there. And as Sean said, if we're consistently seeing errors, we're consistently seeing material misstatements in the work that we're doing, something fell apart back here. So you can't, I fundamentally believe that you can't go to the end of an audit, have 50 journal entries and say, hey, the control environment is A-okay. They have a great control structure, because something is going wrong. Something is breaking, whether it's at the activity level, whether it's at the monitoring activities, at that entity level, somewhere throughout the process, and probably in multiple spots, there's something falling apart that's creating that issue. That's why these items are so foundational to the next steps. Again, if we find an exception here, we have to modify our procedures. If we say, hey, I walked through this instance and they didn't have that dual signature in place for the cash disbursement, how does that change our audit procedures? Do we have an increased level of fraud risk because, hey, they're undermining their own controls? Things like that. I mean, when you think back to some of the greatest fraud cases we think about, it's when controls fell out or were circumvented that things arise and become pervasive issues, or significant amounts of funds are lost. So again, some just best practices here. Ensure that the design evaluation controls they're linked to the objectives to the controls. So what is the objective and what's the related control? Number your controls in the narrative. That'll just help you carry it through easily, help you evaluate doing your walkthroughs. The other thing is making sure the controls are client specific. Again, with the boilerplate forms, you may have a tendency to use some of the generic languaging, really customized to your client, making sure that we're verifying implementation for all of those key controls, and understanding that what can go wrong. You know, you're carrying forward all those risks. Sean's going to cover this in the next section. That's to that 7.1 form, those risk assessment, to then design our audit response accordingly. Anything else, Sean, that you wanted to add before we close out this section?
No, I think we're caught up to date on the chat questions that have come in. So thank you for all of those.
Awesome. Thank you, everyone.
Yeah, and we'll just keep chipping away here. So keep updating. Again, remember, one of the goals, one of my objectives for you is that you take this information, you apply it on your own engagements, but you also share what you believe are best practices with your colleagues, with the people on your team. Maybe in some cases, I know there were some staff in charge, maybe with some of your bosses, right? You can have that discussion with them as well. So as we transition down the hourglass, we're going to spend almost the entire time, a heavy portion of the time, on Form 7.1. I think I make a compelling argument. I'm far from an attorney, but I think I make a compelling argument that the 7.1 is probably the most important work paper or form in your binders. So I want to spend a lot of time with it. I'm going to save a little bit of time to embellish where Faber stopped, where she, in Module 2, she stopped with, this is the minimum you have to do in an audit. I'm going to throw out the concept of testing controls with the hope that you don't disappear early for break. I know many, maybe most of you do not test controls, but we're just going to save a little piece at the end, 5, 10, maybe 15 minutes at the most, and talk about the possibility. Those of you that are doing single audits, and I know some of you do from the chats, you test controls over compliance over those grant funds. So that works in the single audit. What about a financial audit? So I'm going to try to sell you on that a little bit. I'm not looking to change your mind. I'm going to use a word here. I'm just asking that you consider it. That's all. When you get to, we get to module 4, part 4 of this class, you're going to see the different options we have to audit. And one of the options is to test controls. So that's going to be my cell job, to at least throw it out there so you discuss it as a component of your team discussions. So here's where we are. I started out, I got us through here, Faba led us through here. Now we're going to talking about what the team came up with. Those of you that are seniors and in charges with us today, you are probably doing the majority of this work. And then you come down and your managers and partners should be sitting back, feet up, lounging and saying, okay, what do you got? What are your risks? What's your 7.1 look like? What do we need to worry about? That's your job. Everything Faba just covered is generally the job of the senior and staff on the engagement. Not to say managers, you're not off the hook, but you're going to spend a lot of time reviewing that work. So now we get to the middle of the hourglass and we're saying, what are our risks? Come back to that one slide that Faba looked at or showed us. What information are we gathering? What are the risks? And then what are we going to do about it? So that's what we're going to focus on for the rest of the day. How do we utilize Checkpoint Engage to capture all those risks? And you already saw some of the ones she mentioned, that second largest customers not paying their bills. We have a new incentive compensation plan. That's all things that we learned as we gathered information in the top half of the hourglass. Now we have to get it into Checkpoint Engage, get it into PPC's methodology, get it onto the 7.1 form, and then have that linkage that tells us how to audit it, or tells us how they think we should audit it, and then we invoke auditor judgment to decide what's going to be the best way for us. I mentioned very early this morning about the use of the word significant. It's used a lot in the audit standards, probably too much. Generally, I define it using what I said earlier, driving it around performance materiality, taking this word very literally, this phrase. It's the materiality we're going to use to perform the audit, right? Easy enough. The definition under PPC's methodology is on the slide here. It is deemed to be a significant audit area if it contains, I kind of like this in this order. I'd probably flip these for next year. If it contains a material account balance. So from a practical perspective, I usually say if it's a financial statement line item. That to me is kind of an easy shortcut to say if it's a financial statement line item, it's probably a material account balance, meaning it's greater than performance materiality, or could be. That's a terrible could be. But things like accruals, things like accounts payable, certain accounts where we're worried about completeness or understatement. My accounts payable might only be 50 grand, but maybe it should be 10 million. And so when we look at what is deemed to be a significant audit area, I think the practical answer is it probably is going to align with your financial statement line items. If it's part of a significant transaction class, which is what Faba just went over, payroll, accounts payable, purchasing accounts payable, cash disbursements. We often I refer to this a lot of times as a SCOT, significant class of transaction. Same concept, just flip the words a little bit so that I can use some shorter way to say it like SCOT. If it's a significant disclosure, so if we've got a disclosure, it's going to be something that is significant, something we have to audit. And if it has a fraud risk or a significant risk. So from a practical perspective, if you just go with the way I set up my binder, cash, AR, inventory, prepaids, fixed assets, AP, accruals, debt, that's going to be your significant audit areas. The tricky part a little bit in Checkpoint Engage is that you have two different ways to do this. You can determine and establish what are my significant audit areas when I do engagement setup. That's one option. And I don't think there's a best practice here. I think there's two options for how you do it. that you go into engagement setup, and if there's accounts listed that are not significant audit areas, you uncheck them or delete them or whatever you do. If there's areas not listed, then you should list them. That's one option. The other option is when you go into checkpoint engage, and we're just going to show you the end product. But whenever you take, if you haven't done so yet, your implementation courses, your checkpoint engage optimization, and your checkpoint engage point and click and all that, you're going to see that when you go into the risk assessment, the very first question is going to say, is this a significant audit area? Yes or no. You also have to check yes or no there. It's one or the other. Basically, if it's not a significant audit area, you don't have to assess risk. You don't need an audit program. And that's why I come back to this, what I believe is hopefully a fairly straightforward, practical definition that if it's a financial statement line item, probably means it's material, significant. We're going to have to audit it. Therefore, it's going to be a significant audit area. One of Stephen Covey's 7 Habits of Highly Effective People is start with the end in mind. So that's kind of how my brain works a lot. It's not always the best thing, but it's how my brain works a lot. I think about, I know what I'm going to get to. How do I set it up on the front end? The other thing that I would encourage all of you to consider as you're setting up your engagement, as you're determining what are significant audit areas, is an area like AR and revenue. I think that we want to consider the fact that certain financial statement line items may have different, I'm going to try, I was going to say components. I hate to use a word that's used elsewhere in audit standards, but they may have different aspects to them. I'll make it generic. Let me just give you my example. If you're doing a not-for-profit, they may have different streams of revenue. They may have what I'll call normal revenue, whatever they do as a not-for-profit. They may have grant revenue. They may have contribution revenue because the community's nice enough to donate to them. In that case, when you go to engagement setup, you may want to create 3 separate audit areas. One being, again, for lack of a better term, regular revenue, one being contribution revenue / pledge receivable, and one being grant revenue / grant receivable. The reason I say that is because you may want to do separate risk assessments for all those different pieces because the risks may be different. There may be a higher risk around collectability of pledges than there is around collectability of grant receivables, because you've got a written agreement and it's from the government. And even if they sometimes pay slow, they're still going to pay. And so we want to be careful that we don't take these default audit areas and keep them 2 grouped together. So it goes both ways. This is all front end engagement setup type discussion. Very top of the hourglass as I'm setting, it's not really listed in our hourglass, but it's setting up your binder so that you will properly assess risk at the different pieces within a financial statement line item. So I just caution you there to be careful. Now, when we get into the risk assessment, these are all the different risk assessments you're going to make. And as we get into here, there's some definitions that I want you to be clear on, especially those of you that are newer to the PPC methodology. We've got overall risks. I don't use the word generally. I think we only use it, Fabi used it earlier, pervasive. It's not a word I use in my everyday language. I've got 2 whole separate worlds. I talk like an auditor, then I try to talk like a non-auditor if I can. These are pervasive risks. Simply put, multiple accounts or multiple assertions, maybe both. They affect more than one account, meaning I can't hone them down on a specific account or assertion. If I can hone it down, that's what I want to do, because then in checkpoint engage, it's going to go to a specific account. This is an inventory valuation risk, and it's going to go in to its database and pull out audit steps to address it. But I have some things that are just going to be overall financial statement risk, affect multiple accounts. This year, there may be more that say going concern. That's not specific to one account. That's an overall risk that this business isn't going to be be there a year from now. Some of the risks that Faba brought up in part 2, like IT risks, if they haven't turned on passwords or they haven't done certain things that they're supposed to do in the IT system, that affects every single account. Sometimes I hear segregation of duties. Maybe, but segregation of duties might be able to be pushed down. You might say, they only have 3 people, there's segregation of duties issues. Yeah, but where are they? What is the real risk? Well, the real risk is I'm concerned that they might write checks to themselves because there's only 3 people that touch AP and they all touch it. Okay, then push that down to accounts payable and call it a fraud risk. So as specific as we can be on the 7.1, it enables us to link. That's a big buzzword in the standards. And that's what the form allows us to do. And I'll get into that in a lot more detail. When we push down to the accounts and assertions, now we have very specific risks. Unique, one-off. These, you're going to assess all 6 assertions at low, moderate, or high. So we don't want these specific risks to just regurgitate the assertion. I don't want to see in your 7.1 something that says accounts receivable might not be collectible. Well, that's the definition of valuation. If you think that's a risk, just call it high. But if you say, I'm aware that the second largest customer whose balance is $500,000 is not paying their bills, then I probably want to call that a specific risk or a significant risk. This is the process that's the outcome of what Faba talked about in part 2. So let's throw this out there as an example, this type of situation that might exist. Let me push out the my quiz to you. What your thoughts are. This is a situation you could run into. During the current year, your non-public client, let me read it right. Your non-public client issued stock option awards. They've never issued stock option awards before. Therefore, we noted this as an identified risk. It's going to show up on the 7.1. How would you further classify this risk? Would it be a significant risk? Would it be a fraud risk? Would it be a financial statement risk? And I always like 4 choices. I ran out of ideas. Would it be the game of risk? Do not pick that. That was my filler. And so how would we categorize it? So the first thought when you go into Checkpoint Engage is you have to click whether it's a financial statement risk or an account assertion level risk. So the first question, and again, it's auditor judgment. I'm going to make my best guess here, is that my gut feel would say, I don't think it's a financial statement risk because I believe I can narrow it down to specific accounts, whether it be equity, whether it be payroll, depending on how the debits and credits are working. So I feel like I could narrow it down. So that we know it's not this. So that leaves me with these 2 choices. And again, it's auditor judgment. You may have said, I feel like it could be both. Well, it could be. Is there a risk that they would intentionally commit fraud here? Maybe. If you thought there was, then yeah, you should click the button and engage. Fraud risk. For me, if I, just like on the CPA exam, what is the best answer? The best answer, I like a significant risk for the following reasons. And there's some things that I put in here. They've never done stock options before. So it's a unique first-time situation. I don't know much about stock option awards. My only recollection is they can be really complicated. So now we've got a new item that's really complicated. And if you look at the standards, I'm going to try to translate them for you. I think of this, H of H, highest of high. So something would be deemed a significant risk if it's the highest of the high risks on an engagement. And I like the words here, require special audit consideration. So in this example, stock option awards, the client never did it before. And if you want to be negative, there's a good chance you just bluntly say, there's no chance they're going to get this right. There's no way they're going to book these correctly. They don't know how to model it. They don't know how to calculate the valuation. They don't know the debits and credits. okay, then it's going to be deemed a significant risk. And it's usually significant, non-routine, oftentimes judgmental, because now we're invoking some bias in it. And all the standards say, the standards say if you deem something to be a significant risk, there are certain rules around how you're going to audit it. In Checkpoint Engage, there's going to be a question that says, is this a significant risk? Yes or no? And you have to click one of those buttons. So from a practical perspective, if you list a risk and you say, this is highest of the high, there's almost guaranteed chance they're going to get it wrong. It's something that they're not used to. It's too complex. Okay, then click yes. But you may still list a risk and say, yeah, it's a unique risk, but it's not significant, non-routine, the highest of the high. But if we deem it to be a significant risk, the rules in the standards are as follows. And the reason I mention this is I see a lot of 7.1 forms that say this. They have a risk listed, and then it says S, because sometimes teams just routinely click S and call it a significant risk. The problem is, if you do that, you need to do number one. You need to do the first thing on this slide. I've got firms that get dinged in peer review because they deem something to be a significant risk and they do not document whether or not the client has controls in place to make sure that they would catch a big mistake around this issue. Perfect world, if I was Mr. Checkpoint Engage or Mr. PPC, if somebody clicks significant, I would make a text box pop up where you had to cross-reference to where you did the internal control work. So in this case, let's go through and compare it to what Faba taught us earlier. If we say they have stock options for the first time, we're deeming it to be a significant risk. Now go back to Faba's teaching and say, what if they book stock options wrong? Would they catch a big mistake? If the answer is no, then we've got a control deficiency or a material weakness. But if the answer is yes, well, if they booked the stock options wrong, the controller reviews it, the CFO reviews it. There's some control to catch it. Chances are, in a lot of these cases, you're going to come up with a control deficiency because their answer, and you know this, you've lived it, the client's answer is going to be, well, if we booked it wrong, we assumed you would catch it. That's not the right answer. We can't be part of their controls. That's why it's called internal controls, not external controls. So keep that in mind. It's a good double check. It's a takeaway for today. If you look at your 7.1 and it says S in the column, do you have a cross-reference to where you documented whether or not they have controls in place? If we choose to test those controls, or if we have to test those controls, we have to do it every year. That, again, private company audit, we can choose to test. Public company audit, PCAOB, we have to test them every year. And then the last two, I think, are silly. This is me taking a shot at the standard setters. The last two say, well, if it's the high risks, you can't just do an analytic. As if we would say, close enough, stock options looks close. No, if it's the highest of the high risks, we're going to beat it up. I feel like that's stating the obvious. And then the real stating the obvious is, oh, if it's a significant risk, your procedures have to be specifically responsive to that risk. At which point I say, well, duh, you'd say that about anything. So they put some rules in place when they were doing the standards that I think were stating the obvious. But there's probably some reasons why, because people didn't know to do the obvious, maybe. So just keep, that's the takeaway. And again, we'll show you the form where you'll see the buttons that say, significant or fraud. Now I'm going to do this quiz because this is one of my favorite quizzes, and this is an SOB Sean O'Brien thing that my colleagues sometimes make fun of me for. But I want to get your opinion, okay? So we're talking about the audit risk model. Hopefully you're familiar with the audit risk model. AR equals IR times CR times DR. And when I teach, I have a lot of things that I say is the blank of our profession. And so I asked the group, the audit risk model represents the blank of our profession, silliness of our profession, the arrogance of our profession, the professionalism of our profession, the arithmetic of our profession, or I'm just not sure. So what do you think there? I'll explain it. It's an SOB thing that you probably couldn't understand until you hear me say it, but I'll share it with you. So thank you for entering. Oh, I appreciate the honesty. People are like, look, I don't know where, I'm not sure. I don't know where you're taking me. I'm just going to click, I'm not sure. That's fair. I'm going to try to explain to you why I think it's the arrogance of our profession. It sounds so harsh, doesn't it? Here's why I call it the arrogance of our profession. We believe as a profession that we can multiply these letters and words and somehow it makes sense. I find that horribly arrogant of us because nobody outside of our profession has a remote chance of understanding this. Sadly, a lot of people in our profession still don't get it. And I studied this for the exam. I memorized it for the exam, but I couldn't explain it. I didn't really know it. I was in my second or third year and I had a manager. I wish I could remember who it was. I just remember sitting down. They wrote this on a piece of paper and they said, Sean, if you get this, you get auditing. And I was like, wow, I better pay attention. This seems really important. And I'm going to explain it to you the way they explained it to me with hopefully the same outcome. That if you get this, if I can help this make sense to you, you will get auditing. This is how the 7.1 works. This is how Checkpoint Engage works. Our job as auditors is to, and by the way, audit risk equals inherent risk times control risk times detection risk. And IR and CR together make up risk of material misstatement. And you'll see here, I put the O in here for those of you that are super anal retentive, obsessive compulsive, because it would have bothered you if I just put RMM. I know some people like RMM, others that are really literal are like, where's the O? It's risk of material misstatement. Okay, so I didn't want anybody panicking today. We are not done auditing an area. We are not done auditing an assertion within an area. And we are not done auditing the entity as a whole until we can say audit risk has been reduced to a low level. Said another way, we are not done until we can give high assurance that the numbers are materially correct. That's when we know how to stop. That's when we know we're allowed to stop. So how do we get there? Here's the first step, the 7.1 form. IR and CR are the client's risks. We cannot affect them. We have nothing to do with it. It depends, and I'm going to show you all the factors. IR is sort of like the natural risk in an account. CR is a function of how good or how bad the client's controls are. We cannot affect. Our job is to assess. We have to assess those risks, which we do on the 7.1 form. And then Checkpoint Engage multiplies IR and CR and gives us a letter. So again, we're just all multiplying letters. M times M is M, and M times M is L, and L times H is M. So again, it's a little bit arrogant that these random letters multiply and make sense. This is all we can control, detection risk. We control it in one of three ways: nature, timing, and extent of our procedures. That was my big thing. When I took the exam, if the words nature, timing, and extent were in the same answer, I'm like, not check. C, nature, timing, extent must be the right answer. These are our programs. So we assess risk, fill out the 7.1s, and then right here is where Checkpoint Engage does the linkage for us. Checkpoint Engage then goes into what I refer to here as a Cheesecake Factory level of program steps. There's so many in there that it can pick from. The risk, L, M, or H, sort of is how hungry we are. And this is all done by assertion for all 6 assertions. So when you fill out the 7.1 and you say, I am moderate risk for existence, Checkpoint Engage goes in. Every single program step in Checkpoint Engage is attached to an assertion. So it goes in and says, oh, moderate risk for existence, what are the best steps that I should pull? And it's all programmed behind the scenes. This all happens behind the scenes. And what it gives you, and I'm going to be very clear on my words here, it gives you a starting audit program. You still need to invoke auditor judgment to make a decision on the final audit program. So it does all the work for you. It gives you a starting audit program. It doesn't do all the work for you because you have to do all this using all the information that Faber talked about in part 2 and say, okay, what are my L's, M's, and H's? Fill them in. My testing controls or not, fill it in. And then magically hit the button and it gives you an audit program to start with. If you get this, if this made sense to you, you get auditing. This all flows right through the middle of the hourglass. This is the middle of the hourglass right here. We finalize risks, and then the next step, we've got audit programs that are responsive. We don't want to do not enough work because that means that we could get sued, we could lose our licenses, we could lose the reputation of the firm. We don't want to do too much work because then we lose our personal life. And we've all been there. And that's usually what happens. I'm doing too much work, so I'm working till 9 at night or I'm working on the weekends. This helps us to get to the right amount of work, but not without auditor judgment. That's how Checkpoint Engage works. That's how PPC's methodology works. And the biggest difference with technology is I'm not starting out with a program that has 50 steps in it and I need NA 45 of them. It's giving me a really good starting point for a program. But that doesn't mean that I just blindly accept it. I still need to invoke some judgment and decide how I'm going to address those steps. So hopefully that made sense. Hopefully I did not pull a Billy Madison and make you feel dumber for having listened to me for the last 4 minutes talking about the audit risk model. Arrogant as it is, if we can understand how these multiplication of letters and words works within our audit, we're going to do much better audits. This is PPC's risk matrix. Those of you that are with us today that have come from a different methodology like RSM, this is one of the different things for you all, because RSM didn't have low, moderate, or high. They just said, is it a risk or not? Here we've got these 3 gradations of risk. And I will talk to you in a minute about how we support those, how we document those. But what I want to get at here is most of you are going to be working in this box right here. You are at high control risk if there's no test of controls or if you have control deficiencies, meaning the client doesn't have controls. It's one or the other. Or you may say, look, they have controls. We just choose not to test them. This is a key takeaway under this methodology. In order to lower control risk to moderate or low, you must test controls. I see firms all the time. I even hesitate to say it because if you don't do it, I don't even want to put it in the back of your head. But they'll say, oh, control risk is at low because the client has really good controls. No. You can, and this is what we'll finish in this module on in an hour, is you can only lower control risk if you've tested controls. And I'll show you the matrix to get us there. So most of you are going to be working in this aqua blue box. Now, one of the things that you will see that can be a little bit confusing is 6 of the 9 answers to the multiplication of H times L and L times H and M times M has a range in it. The way that Checkpoint Engage is programmed is that you will drop in an inherent risk, you would drop in a control risk, and the suggested answer it gives you will be the left end of these ranges. The good answers, frankly, they will give you the left end of the range. So M times H will be M in Checkpoint Engage. L times H will be M. And the way I try to teach it practically is that's a good answer if you got to FABA's D&I, meaning the client has controls and they're doing them, Because it's a private company audit, we've elected not to test controls. So I'm on the left end of the range. But let's say you go in and work with the client and you say they don't have controls or they're not doing what they should be doing. That could be an indicator that M times H, because I'm going to give you the definition in a minute. Inherent risk is before you even consider whether or not they have controls. So this is the first step that you do. Then you do this step, and then you verify what you like for the letters. So it's always going to default to the left side. You may have reasons to bump it up to make the risk higher, but that reason should normally be tied to the fact that you have a control deficiency. Remember, I guess it was right at the end. I don't think it was before our lunch break, but it was when we came back. I said, it is so important to make a good decision about D&I. It's so important because if we botch that decision, it could affect where we end up in our 7.1. And based on the audit risk model, every time one of these letters changes, checkpoint engage goes in and theoretically gives different program steps. May not be huge difference, but it should be a difference. Because if the risks are higher, then I should be doing more or different procedures. If the risks are lower, I should be comfortable backing off. I shouldn't need to do as much work. So that's how the audit risk model works. Faba, any thoughts here? I just need to take a sip, and if you can banter for me. Anything that confused you, Faba? I know Faba's still fairly new. Her firm, the firm she worked for, they utilize the audit risk model, but every firm looks at it a little differently. So anything that you can share, Faba, either that you've learned since learning PPC or any way that you can reiterate something I said to maybe make it more sense.
Absolutely. I think the methodology that I came from definitely had similar ranges when it came to and really encouraged that auditor judgment. And so I think fundamentally it comes down to defending the positions. I know Sean has probably mentioned this previously, but we really need to document why did we land at a specific spot? So what inherent risk did we choose, and why did we land there? Is it because there's issues in the control environment? Is it because the control environment's great and we think, or if there's some level of complexity, what are those inherent risk considerations that we need to do? We need to document that. I think historically auditors had the tendency of, hey, I'll just make everything high. I'll just test it and hey, I'll just be more conservative, right? And that's not what the standards require, unfortunately. The standards require us to justify our position. And so I think that's what I've seen in this area is the biggest challenge, really pushing teams to say, hey, why did you make this conclusion? What did you, and how did we document it? How do we capture that in our work papers and our risk assessment forms?
Thought we rehearsed this, and trust me, we did not. But she just teed up the next slide for me, which I thank her for that. So every time that we pick an L, M, or an H, we need to support that assessment. I mentioned that one of the first things I mentioned in those user questions. Do I have to document my risk assessments? Yes. This is very high on the peer review checklist. Firms are getting nailed for this. These are the 8 factors to consider under PPC's methodology. So if you pick L, M, or H, and if we were doing it live and I was working with you on a consulting project, you said, I think risk is high. Okay. I ask a real simple question. Why? It's not a great why, but that's what I was. Why? Why do you think it's high? Why do you think it's moderate? Why do you think it's low? And you should refer to some or all of these 8 factors. Now, this is not meant to be a checklist. This is not meant to be a vote. Oh, I got 5 factors versus 3, so it's still auditor judgment. Me personally, I weigh some of these a little bit higher. History of prior year misstatements, I weigh that pretty high. If the client always messes this up, guess what? They're probably going to mess it up again. Therefore, the risk is probably high. I think Those four I probably put much higher. The nature of the items. This is going to be balance or activity. If it's the bigger the balance, if they've got 10 times materiality in fixed asset additions this year, that to me is a higher risk than if they only had, a couple thousand of fixed asset additions. A lot of activity, right? The need for judgment, bias. Humans are getting involved here. There's estimates. That pushes me up the scale a little bit to moderate or high. And depending on how complex it is. Accounts payable for cutoff, theoretically not complex. It should be fairly easy to say this should be booked in January or December, July or June, whatever it is. But stock options, VIEs, hedges, derivatives, pretty much if we put a list together of complex items, it would mirror the list of things that pushed me out of public accounting because it became too complicated for me to understand. And so I'm like, I'll just go teach it instead. This is what you should be documenting on your 7.1 form. Answer the question, why? Now in Checkpoint Engage, there's going to be a couple different ways to do that. I'm going to show you some examples, and I'm going to show you a way you could do it. Now, when you went through your implementation training, and you've seen those of you that are adopting Checkpoint Engage, you saw some of the points and clicks, and where do I type here, where do I type here? I'm focused a little bit more on the wording. I don't care if my answer is I don't care where you put it. Find a place to put it. Click on. It's like the little I don't know. I guess it's like a comment thing. It's not the best one I've ever drawn. Looks more like a tornado, but it's like the little the bubble, like the speaking bubble. Any of you using Smart, it can be done on a little yellow Post-it note. I don't care where you document it, but for every letter that is in this column, you need to document it. So here's what we wrote. Again, I'm not saying it's perfect, but here's what we wrote as an example. See, example, not perfect world. IR has been assessed at low for all of the assertions other than cutoff. Hang tight on cutoff because, and come back to some of those 8 factors. The transactions are not complex. They do not require judgment. They're comprised of large volume of small dollar transactions. So it's not like one transaction is going to mess this all up. There are no accounting and auditing issues. And as I said, I put very high. I might have wrote this first. There are no adjustments in the prior periods. Cutoff has been assessed at high inherent risk because we've got an identified risk here. When they identified the risk and they called it a significant risk, they said, we think there might be improper revenue recognition due to fraud because the company might move January sales into December. So they might intentionally manipulate it. So based on that, that's why we would have cutoff as high risk. I don't care in the end where it's documented as long as it's documented. Tell the story. Now, the beauty of this and what I often see in practice is that when you are put into a position, say forced to document this, a lot of your answers change because some of this has been carried forward for 10 years. Other, you just like, I don't know enough, or I'm just not sure. So I pick moderate because it's in the middle. It feels safe. And so it's interesting whenever I work with a firm and I'll say, okay, assess risk. What is the risk for AR for existence? Low. Why? Verbalize it for me. Because you have to type it in here somewhere. And sometimes when they verbalize it and they go over these 8 factors, sometimes their answer changes. But it's all good because now they've thought more about it. It's become a better process. It's become something that they can say, I feel more comfortable. This is such a critical piece because once these get established right here, these answers are what goes behind the scenes in Smarter Checkpoint Engage to generate your starting audit program. And it does it by assertion. So it's going to go in and pick audit steps that should align with moderate RMM for 5 of the 6 assertions. For this one, it's probably going for cutoff. It's probably going to pull a lot of steps. then your job as the auditor is to go in, look at what the program says, and agree or disagree. You might feel that it brought in too many steps. You may feel that it didn't bring in enough. So or you may need to go in and tailor those steps. So I'm gonna do a quiz here first, and then actually I'm gonna do this quiz, and then I'm going to go in and demo the form. And please chat in questions. Please keep, you can come off mute if you want to just ask the question. If it's easier than typing it, you can feel free to do any of that. So here's an example. I think this is very real life. You've got a client, and this year there was a change. Remember Faba's question, hey, what's new? What's new? In order to boost sales this year, your client changed the way salespersons are compensated. Last year, salespersons got a base salary. This year, they earn commissions and they must comply with sales quotas. They're also eligible for a bonus based on annual sales. What type of risk do you think this creates? Is it an overall risk that affects a bunch of accounts? Is it inherent risk based on those 8 factors? Is it an assertion level risk, or is it a detection risk? I will tell you, after teaching this class multiple times this year, I think there's a strong argument for 2 of the answers. This probably isn't the best question, frankly, but I'll explain. Now, I do believe there is a best answer. And then there's one that's like second best, but 2 that I don't like at all. So how about that? Does that help you? So let's take a look at what you came up with. You guys are pretty even. You got the 2 answers that I like most. You're there. So let's go back and let's talk about these. So the first question is the way to think this through, because you now have to make a decision. You go into Checkpoint Engage and you type this. Now the first question it's going to ask you is to pick between A and C. Is it an overall risk or is it an assertion level risk? I believe, and I would argue, I think that I can narrow it down to revenue for existence or occurrence or cutoff, because the salespersons, they do have an incentive because they get commissions. They have to meet sales quotas. There's pressure. They get a bonus based on annual sales. Annual tells me they either have an incentive or a push to book sales that either don't exist or book sales sooner. In other words, maybe taking some January sales and getting them into my annual bonus. So if I feel I can narrow it down, which I think in this case you can, I would probably rule this out. Now, detection risk is auditor response, so we can rule this out. Now, the reason I'm like, I should have changed this, the reason that I think B is a pretty good answer as well, although not the best answer, is because once this is created, chances are the fact that this exists is probably going to increase risk for cutoff up to moderate or probably high because of the significance of this change in the way the salespeople are getting compensated. So I love the answer C. B is a good number 2. I would have given you partial credit for that one. So this is what happens when you go into Checkpoint Engage or Smart, depends on what you're using, and you identify a risk based on what Faba talked about in part 2, and you hit the button that says add risk, then it starts populating screens that gets you to the end answer. And the first screen is going to be, is this an overall financial statement level risk, pervasive, affects multiple accounts, multiple assertions, I can't narrow it down? Or is it an account assertion level risk? Now, the bonus, the reason I want to push this down to cutoff especially, is now I'm going to have an audit program that's better suited to audit this risk around cutoff. So I'm going to let Checkpoint Engage or Smart do their work. But it's only as good as me setting up the risk in the right way. The 2 keys here are, 1, making sure that I actually identify the risk. I don't know how good I would have done in my career. I would have had this information. I know I would have got this information put into the 3.1 form. Would I have recognized it as a risk to get it into the 7.1 when I was a second year person? I'm not sure I would have, but that's what your teams need to do. Those of you that are managers and partners here, those of you that are seniors and staff, this is what you need to do. If the client tells you something is new, something is different, you have to decide, does this translate to an audit risk? And if it does, we got to get it out there as an audit risk. We need to get it set up as such. Otherwise, it slips through the cracks. And we get to the end of the audit and we haven't changed the way we audit cutoff, but we should, because there's different risks this year. Once we identify it as a risk, the second key part to make the methodology work is to make sure that I'm picking the right aspects to it. I'm picking the right attributes, whatever words you want. That I'm identifying it for the accounts that it affects. I'm identifying it for the assertions it affects, so that I can have a very strong response to this risk. I told you before that my brain often works backwards. And so sometimes when I work with a firm and I look at a firm's work papers, I look at it backwards and I say, you're doing this audit step. Why are you doing it? Work backwards to tell me where in the 7.1 is this risk such that you're doing this audit step. Is it just because existence is high risk, or is it because we've listed a unique specific risk? So in this case, I would get it out on the 7.1 and I would pretty much write what we wrote here in this polling question. This is the situation, blah, blah, blah. We believe there's a risk around cutoff. We think that the salespeople might take January sales and push it into December. And then we have an audit response. We might pick some significant large transactions at the end of the year that got booked in December to make sure they closed in December. We might do a high level analytic and look to see what the sales are in the last 5, 10, 15 days of the month compared to the first 5, 10, 15 days of the month. So we've got some latitude there. We have the ability to respond accordingly. Let's see, we have a couple chats that came in, so that's terrific. In Checkpoint Engage, where it says significant audit area, does that equate to overall risk? So no, technically not. So when you go in, when we determine something is a significant audit area, that's going to be our starting point in the engagement setup, or in the 7.1 form, the very first question says, is this a significant audit area? If I click yes, then I'm going to go in and assess risk. The overall risk, whenever, and again, I apologize, I don't know all the buttons, but I know in Smart, there was a button that said add risk. And I think it might say something similar. You click a button, it says add risk, and then you get a pop-up. And the pop-up says, describe the risk. And so you type in salesperson, blah, blah, blah. And then there's another couple of buttons there that says either is it an overall risk or an account level risk. If you check overall risk, I think you're pretty much done. If you check account level risk, then it gives you another pop-up. So you keep going down the path, and I'll show you the end product. Then you get down and it shows, then you get another pop-up that says, now click which accounts and which assertions it affects. And so in this case, if the client told you this, the first step would be, I got to get this on the 7.1 form. So I'm in Checkpoint Engage. I'm in the 3.1 form. I type up my answer. Oh, there's a change here in the way they're compensated, blah, blah, blah. I would click the button that says add risk, pop up, describe it, copy paste it probably, and then go in and say overall or assertion level. I think it's assertion level. Boom, pop up. Which account? I would click AR, I would click revenue. And then there would be 6 buttons below that say existence, occurrence, completeness, valuation, rights and obligations, accuracy, classification, and cutoff, and you pick which assertions. Once you've done that and you click next or end or whatever it is, it now is going to flow, and I'll show you in a minute. It now flows to the 7.1, but behind the scenes now, it's starting to attach to program steps in Checkpoint Engage, so that when you create the program, it's going to give you more audit steps as an option to test for cutoff. So I hope that helps. I'm going to show you the form here momentarily, and I'll try to talk you through that and regurgitate it a little bit there. Fabe, anything to add while I transition?
No, I think you covered this on this one.
That's all I had. I should have left something for you so that so you could banter while I transition. So again, I want to be very clear that this is the end product. This is the end product in Smart and PPC tools if you use the platform. It's going to look different in Checkpoint Engage, the way you do the inputs, but the concepts are the same. So we wanted to kind of take it down a level to the foundation so that if you understand what it looks like and what this form does, the pointing and the clicking and the pop-up boxes should be pretty easy for you to deal with on the front end of the work. So you can bring this up on your own. I'm going to scroll through it. I'll slide over the instructions because you don't read them anyway. I know that's like the 8th time I've taken a shot at you, even though it's a shot at Fabe and I because we did it as well. So if we think back and we try to connect part 2 to what Fabe talked about here, this is an example. Now, again, it's going to be slightly different in the way it looks in Checkpoint Engage, but it's the same concept. So let's think through this case study. I'm interviewing the client, the controller, let's say. And Fabe showed this in the 3.1 form. Hey, what's new? Oh, you know what's new? It's so good for me because I'm the controller and I'm part of this bonus program now. So the board adopted this new incentive compensation program. The bonus program will pay the executives, right? What was in the 3.1. So the only difference I would make here is me personally, I would probably say, see, and you might have your own numbering system. 3.1 question, whatever it was, 16. I'm just making that up. But I like to have that cross-reference. Now, I do like the cross-reference where we say the formal incentive compensation program or plan document was obtained and it's sitting at work paper here. So it's sitting there somewhere. Then we make a determination in Checkpoint Engage. It'll say, is this a fraud risk? Yes or no. Is this a significant risk? Yes or no. And depending on what you pick, it will populate the S or the F here. In this case, we kept it simple. We said it wasn't. It's auditor judgment. Pick what you want. And then on the right, it allows us to put an audit response. So to the chat question, and one of the things here, we put this in and we said this is an overall risk. So that means it's going to affect many significant audit areas. And so because we said they get paid a bonus based on net income right here. So yeah, the actual bonus accrual could be attached to some liability, but this to me is more pervasive because how or what could they do? And as I talk it out loud, I'm thinking, I probably should call this a fraud risk, and maybe even a significant risk.
I was thinking the same thing, Sean.
Yeah, I know. As you talk, it's like I talk myself toward a corner there, and I'm like, oh, well, I'd probably change this answer. So, because they have bias. So you say, well, that only affects accruals. No, the actual recording of the bonus only affects accruals. But how would they adjust, play with, or make errors in net income that would raise this bonus? It could be in anything. They could book revenues too soon. They could adjust any estimates, which could be in inventory, in AR, in expenses. It could be anywhere. So that's why I would deem this to be an overall risk. And that's why it shows up in the top part of the form or in Checkpoint Engage in a separate section that's called overall risks. And then over here, we create our linkage. So here's the risk. What are we going to do about it? We tell the story. And then ultimately, these things need to hit an audit program somewhere. So we say, here's the risk. What are we going to do about it? The team will obtain and examine. I like the word examine. It sounds Sounds really in depth, right? Not just we will obtain it. We're going to obtain it, read it, examine it, conclude on it. We will increase professional skepticism surrounding estimates. Everywhere we're auditing an estimate, we're gonna take a harder look at it than we did last year, because now there's bias. Because for every additional dollar in net income, maybe the controller gets an extra dime in their pocket as part of their bonus. We will do retrospective analyses on significant estimates. Side note, that's required anyway, but we highlight it here so that we're going to take a look at some of these estimates today versus a year ago and see how good they did. In other words, were they playing with the numbers? Softly playing. Now, I'm not saying fraud, but softly playing with the numbers. We have to do journal entry testing. So here we're going to perform examination of non-standard journal entries, focusing on entries near year end that increase net income, either increase revenues or decrease expenses, because that might be an indicator that they're playing with the numbers. We will audit the calculation of the incentive compensation program at the end of the year, and we will determine the input. So whatever that input is, net income and any other assumptions made by management. So this tells the story. I would take these and now not all of these steps. I mean, this step is not going to be something that magically comes out of Checkpoint Engage. So you're going to have to go in and create a new audit step in the accrual area and say this: obtain the calculation of ICP at year end, determine the appropriate inputs, conclude on any assumptions, examine subsequent disbursement that's made on March 15th. So this is one of those times where we've done a good job of identifying the risk, but Checkpoint Engage doesn't have they don't have every single possible audit step that can exist for any possible risk. So you as the auditor are probably going to need to add some audit steps here to add to that. As I scroll down now, by the way, this is good information here. I know you won't read it, but you really should. It's really good. And again, Checkpoint Engage, anytime there's, I think, blue, you can click on it and gives you a pop-up. It's like a link to the guidance. So you can read, understand these definitions, understand how these columns are supposed to be used, understand what the assertions are. It's good stuff, but we'll skip over it for now to show you the example that we put in for accounts receivable. So remember, working from the case study that FABA started, we had this discussion with the AR manager. Second largest customer is not paying their bills. They're on the verge of bankruptcy. It's a really big amount as of October 31st, so it is a risk. We've deemed it to be a significant risk. We were able to push it down, so to speak, to accounts receivable and revenue, and probably push it down to valuation, which is why you see right here, we've deemed valuation to be high inherent risk. All the control risks are high because we're not testing controls in this area. And we've had some other assessments now. I think for purposes of the illustration, we did not provide you explanation for the inherent risks, but that would come right below here, or it would be somewhere on your Checkpoint Engage. So for all of these, we need to have those sentences referring to those 8 factors to cover our butts for why we have H's, M's, and L's under the inherent risk column. And then we've got the comment section. So again, what the comment section, let me scroll up a little bit, is that it says linkage / comments. So linkage, here's my risk. What am I going to do about it? Now, these items would get copy pasted into Checkpoint Engage into the audit program part, because we want an audit program. So we said, what would be our audit program? When we come out to do the year-end audit, sometime probably in February or March, probably March, we're going to inquire as to the AR manager whether or not this balance has been collected or how much is still outstanding. They may say it was all collected by the end of the year and this entity is doing better and they are paying their bills and we could see that there's no outstanding AR. We might be done auditing it. In other words, the risk went away because they paid their bills. If not, they say, we're still not sure if they're going to pay it. Well, can we see what they paid all the way through the end of February? So maybe they just paid it late. Again, we're trying to sign off on a balance as of 12/31. Is it collectible? So if it got paid in January and February, that's evidence that it was collectible. I can live with that. If not, for any amount still outstanding, if they haven't reserved it, we're going to propose an entry. So if it's still all 600,000, that, by the way, is no longer 90 days old, I can't do the math. November, December, January. Now it's, 210 days old. It's maybe not collect. We're going to reserve it. We're going to propose an adjustment that the client may agree with or may not agree with. We'll talk about that in part 4. But this is our audit approach. This is the linkage. Now, some of these items aren't, this isn't going to be something that's automatically generated out of Checkpoint Engage. You might have to type this up as an audit step, and there's nothing wrong with that. That's perfectly fine. So that's the flow, starting with the top of the hourglass. The work Faber did, she understood and said, I'm doing the 3.1 form. I talked to the AR manager. They're concerned about this customer not paying. Your job as the auditor is to hit that button that says add risk, to get it into Checkpoint Engage, to click AR and revenue, to click valuation, and then it's going to show up here. And then behind the scenes, it's going to generate some audit steps. Now, it may not have generated all these audit steps, so then we just go in and add them. IR times CR times DR. That's what we're striving toward. Please keep chatting in questions. So as I scroll through here, this is what happens. You have to do this for all of the significant audit areas. As soon as you click yes, or you do the engagement setup that something is a significant audit area, then you have to assess risk. The couple other things I want to chime in on, and I'm going to go back to my slides, I think, to do this one.
And while Sean is switching over, one of the things that Sean's mentioned this a couple of times, but that customization that, hey, this is not a standard step, but I need to do this in order to address the risk at my client, that's super important. We're going to cover that in the last section, and we're going to talk about modifying programs and such, but we can't stress enough. You want to make sure that you're customizing those program steps for your client. And that could be that you're modifying an existing program step, or, hey, this is not something that's standard. It's not boilerplate language. It's unique to my client. You want to make sure you're building that into your audit program.
And so 2 other takeaways that I want to be clear on before we switch gears here is there are 2 risks that PPC is going to pre-populate for you. One is management override, and the other one is improper revenue recognition due to fraud. Now, we did an okay job here. We didn't do a great job, but we did an okay job here. Both of these risks, again, takeaway for today, they need to be edited. They need to be edited for your particular engagement. So how would management override controls? The most common way is they would book what we used to call topside journal entries, JEs. So we close the books, all the controls are in place, all the reconciliations are done, all the reviews are done, and management looks at it and says, we didn't hit the number we wanted to. We're going to override controls and book a journal entry. Debit AR, credit revenue. Oh, we hit our number now. So management override of controls is a fraud risk. And generally our audit procedure, if when it exists at all times, because any management can override controls, is usually to review journal entries. But we should edit that management override of controls and then add how we think management would do it. Probably more importantly is the way PPC has it set up. All it's going to say is this: improper revenue recognition due to fraud, and then it holds a place where it lists all 6 assertions. Every team needs to go in and edit that. edit it and be specific based on your fraud brainstorm for how management would have improper revenue recognition due to fraud. What would they do? Would they create a fictitious customer? Would they intentionally manipulate estimates around returns? Would they intentionally manipulate allowance for doubtful accounts? Would they book January sales in December? Would they book not-for-profits? Would they book pledges that don't exist? Would they book pledges intentionally based on just some oral explanation because someone said, hey, yeah, I'll give you 15 grand for that project. There's nothing in writing, so they just book it. You need to edit that and narrow it down to the assertions that it affects. If you leave it generic, there's two things that are going to happen. One is you're not going to know how to create an audit response to it. If you don't have a specific audit risk, you don't know how to respond. Worse yet, if you leave it generic and you leave all 6 assertions attached to it, a peer reviewer has every right to say, oh, you thought fraud could occur in all 6 assertions. Show me in your work papers where you address that risk for all 6 assertions. And your only defense is going to be, oh, that was our fault. It really wasn't any of these. It was just cut off. And here's where. So your only defense is we messed up. We put the wrong stuff in risk assessment, but it didn't really exist as a fraud risk. So that's one of the big takeaways. Make sure that we edit all of the risks. I said both of the risks that are pre-populated by PPC. Any other chat questions? Anybody want to come off mute and ask a question as it relates to the 7.1 form or the risk assessment process? We are at the middle of the hourglass. Now, I know it's taken us like 6 hours to get to the middle of the hourglass. That's kind of real life. That takes a while to get to the middle of the hourglass if we do the audit right. So please chat anything in. I'm going to just take a breath here, and then we're going to spend the last, we go till 4, right? So we go to the top of the hour. I'm gonna finish up with some best practices in risk assessment, and then we'll spend to the top of the hour talking about testing controls. And Fabe, if you have any last 2 cents,
I would say
please do.
Just to echo what Sean was saying, this is an area that I consistently saw folks not customizing, and it is very hard to make the argument that improper revenue recognition is the same for your consumer goods client as it is for your not-for-profit, as it is for your healthcare entity. Revenue is different, and how they book revenue is different. Your risks related to fraud are going to be different. Your risks in general related to improper recognition, whether it's manipulation of estimates, all of that's going to be wildly different client to client. So you really want to make sure that you're customizing it. I think in the past, especially early in my career, we would have easily gotten away with this. I think this is an area that peer reviewers, the profession as a whole, has really put more focus in and said, hey, this isn't just a standard boilerplate. We really need to customize it. We really need to make it a little bit more robust. What does it mean for this specific client?
Yeah, and some teams, they just don't get that, and they just leave it as is. They leave it boilerplate written by PPC, and right or wrong, PPC, Checkpoint Engage, they're putting it there because, frankly, if they didn't put it there, probably none of the risks would show up. But they are presumed fraud risks by the standards. So that's why it's in there strictly as a holding place. And the better job we do editing it and being very custom, client-specific, detailed, the easier it'll be under the audit risk model, the X, to tie it to the response. So hopefully that'll help and that'll make some sense for all of you. So here's our best practices. I really like the first one. I think that it's a healthy exercise that once you have established the 7.1, especially maybe in a year where you're doing it for the first time, those of you that are switching off of RSM that are with us today, or if this is the first time you're really giving it some deep thought compared to the last 10 years when it just got carried forward. I think it can be really valuable to go over it as a team. I don't care if it's 2 of you or 6 of you, whoever the team is, to make sure we're all on the same page. To the extent you can, any of those risks that you're putting on there, and we just preached about management override and improper revenue recognition due to fraud, but don't forget all the others. If there's any other one-off unique, the stock option one, if that is something that is unique, make it as specific as possible in how the error would occur, so that you can then have a good detailed audit response. I know that our stuff doesn't illustrate it as best as it could here today. We'll clean it up for next year, but cross-reference when we can, either by a work paper or mostly to a work paper. I don't see a lot of every firm has their own indexing system, or cross-reference it to the form number. I'll make that typo too. Make sure you document IR rationale. If not, the peer reviewers are going to attach to it very easily. Last one, edit those generic responses to entity level risks, which is management override. And the responses, again, PPC gives you some basic responses. We will increase professional skepticism. We will do tighter supervision. We will assign the right members and more experienced members to the engagement. Don't allow that to be in there. Don't allow that to be left don't allow it to be left in the form if you're not going to do it. And I see it all the time. It says, we will assign more experienced members to the team. And I talk to the team, like, oh, so who did this audit? Well, all we had available was an intern and a new hire. Like, then you didn't do what it said. You said you were going to assign more experienced people. How much less experience can you get? A high school guy, high school gal to do it? Come on. Somebody in college, that's the intern, right? So, be careful, be mindful of that. We want the 7.1 to tell the story. And most importantly, we don't want the 7.1 to get us into trouble. That's the big thing as well. We don't want it to get us into trouble because we leave something on there without editing it. So I hope that was helpful. Again, please keep chatting in. We appreciate all the comments, all the questions. And then I'm going to finish up here last 15 minutes. Don't leave. Don't disengage, because I want to talk about testing controls. But here are our options. And you heard, I thought it was kind of almost appropriate that Faba, when she did part 2, it carried over into part 3 a little bit, because there was so much to talk about internal controls, just to get to the minimum required. That's all we were trying to get to, is minimum required. It's a lot of work. And so if we're doing all that, could we test controls? Well, sure, we could. Do we like to? Probably not. Do we want to? Probably not. So there's a lot of different options there for whether or not we want to actually go through with it. So here's my cell job. I got a couple slides and then that's it. And we're going to take our break. This is what is required for all audits. Implementation, D&I. Design and implementation. That's a terrible D. We do it every year. We corroborate what the client tells us by inspecting, by observing, by watching them do it, by trying to break it, by asking them additional questions. And we conclude that the control was implemented at a point in time. This is the minimum. This is what Faba covered in part 2. Those of you that have done it, this is not a 5-minute exercise. This takes a lot of time, because you have to do it for financial statement close. You have to do it for payroll. You have to do it for AP. You have to do it for revenue. I would argue on nearly every engagement, you have to do it for those 4. But then you throw in not-for-profits. You've got contributions. For manufacturing distributing, you've got inventory. You may have debt or equity on some clients. For banks, you've got loans and deposits. There's a lot to do. That is the minimum. Now, what if I can take advantage of that? And remember what you're saying when you get to the minimum. You're saying they've got controls that are designed appropriately, and from everything I can see, they're doing them. But I only saw them do it once. So I cannot lower control risk below high. But if I do some additional testing and I conclude that not only did they do those controls when I saw it in the walkthrough, they've done them all year. That's what I'm trying to get to. And I learned this lesson very late in my career. I wish I'd have learned it earlier, but I had a partner who said, we tested controls, change your mentality. I don't know what you mean. He goes, we tested controls. What does that mean? I go, it means they did control. No, he goes, what does it mean? It means they had controls in place all year, so they would have caught big mistakes. Yes. So what does that mean about the numbers at year end? They should be right. He goes, then start doing the year end audit with that in mind. And it changed the way I looked at things. Meaning, if we say we tested controls, we should walk into the end of the year saying, these numbers are right. Because they would have caught it before we got the trial balance. And this is what the biggest impact is right here. It should reduce the amount of work we do at the end of the year. I might be able to do more analytics because I've concluded that the controls worked all year. Now, we have to do that for public companies. And everyone does it because it's required. We do it for single audits for compliance around grants. Why? Because it's required. But we don't always do it for private companies because it's not required. That's okay. It's an option. So all I'm trying to get you to is consider. See the word consider here. Just consider it. When should I? Well, only if they're designed effectively. If I've got control deficiencies, it's illogical. Why would I do any testing? Makes zero sense. If I have trouble, if I can't do substantive procedures, if substantive procedures can't get me enough evidence, or if they're difficult, then maybe I want to test controls. And mostly, it's whenever test of controls is more effective or efficient. If it's equal or better work in at least less amount of time. So then here's what I'll leave you with, and then we'll take a look at the forms briefly, and we'll call it a section, and we'll come back and finish up for the day. Remember, this affects the CR. My CR moves to moderate or low, so it changes where I'm at in the matrix. I'll show you on the next slide. Mathematically, if my RMM goes down, my sample sizes go down. So now if we start to put together some of the things we talked about today, part one, what if my materiality goes up a little bit? What if I test controls and I might have a really small sample size left to do in the heat of my busy season when I'm working until 9 o'clock at night? I might use higher scopes. I might be able to do analytical procedures. I might be able to replace test of details with some analytics. Remember, this is where we're working. If we test controls, we can lower this. We can move it from left to right. And then my risk of material misstatement goes down. That's how the translation works. That's how checkpoint engage works. And that's how it works in the context. How many do I have to test? Depends. It's real simple, though. It depends on how many times a year the control happens. So this is the large population. In PPC's methodology, generally they define large as really things over 100. But usually it's happening every day.
Sean, I don't know. I could just be me, but I lost your audio.
I lost it also.
Hold on one second. Perfect. Yeah, I can hear you now.
You picking me up okay now? All right, my headset ran out of battery. Thanks, guys. I didn't talk for the last 8 minutes and you couldn't hear me. I appreciate it. So bear with me. I don't know if this sounds a little echoey. Also a function of these wireless headsets that obviously can't last a day without needing charged. So what I was getting at, when I was on a roll, I was saying, what if you can find a control that only happens 12 times a year? For instance, monthly reconciliations. For instance, at a lot of your clients, by the way, that was not a test to see if you were all paying attention and you would chat me to say that I lost my audio. But not a bad test if I'd have done it on purpose. But one of the things that I really like as a control is a lot of companies do budget to actual. And I like that a lot because it's their ultimate control. They close the books and then they look at the budget to actual and say, do any of these numbers, these actual numbers, look off based on what our budget was? And based on that, they will go in and review and evaluate and make adjustments. That only happens 12 times a year. So you can't go in and do that 25, 40, or 60 times. So it's an option. I'm just going to leave it at that. It is an option. To close out the section, I'm going to share my screen. And I'm going to show you the 2 PPC forms that you can use to test controls. Now, I need to check. I know there are 2 forms here. I don't know if they got merged in Checkpoint Engage. I've always said, I don't know why there are 2 separate forms. I wish they were just one form because there's a little bit of duplication on them. But the first form is going to be 10.1, and you should have this form if you want to look at it by yourself. If not, you can look at my screen here. And on this form, it just goes through and talks you through, here's the testing that I'm going to do. So let me just chat with you on this and talk you through it. So it asks, what is the control I'm going to test? And depending on how you number your controls, you could either copy paste the control as it's written, or you might have a cross-reference. If you've numbered your controls, you might say it's control C1 or it's control 1002. And then you have a description of the control, again, which is probably copy paste. And so you identify, here's the control I'm testing. Now, I want to be very clear here. Faba talked about doing walkthroughs. I'm not talking about doing 12, 25, 40, or 60 walkthroughs from birth to grave transaction. Those are called TOTS, we used to call them, test of transactions. What I'm talking about here is actually testing the control, seeing if there's a signature on an invoice. That's all you have to check. If they say our control is that everybody signs the invoice authorizing it to pay. Every check has 2 signatures. Somebody signs off on a timesheet. Anybody that gets a pay rate change, there's a signature on some pay rate change form. That's a test of control. It usually doesn't take that long. I know walkthroughs take long, and that's not what we're talking about here. Did I test the controls in a previous audit? Yes or no? Did I test the controls at an interim date? Yes or no? Which is a bonus. You can test controls at interim and then just verify that same controls were in place the rest of the year. And then you document, what is the control that I'm doing? So again, you might say C1 here. I'm testing existence, and here is my test. And then who did it? Did it pass or not? And then a cross-reference to where I did the test. So it's just a documentation of your actual testing approach. And then down here is a good double check, because if you only tested for existence, then maybe this one becomes L. And again, I know it's not perfect because I'm just kind of slapping it in here. But maybe the rest of the 8 and 8. And these would agree to your 7.1 form. The other key point I want to make here, and the reason I did it this way, is when you test controls, if you choose to test controls, you do not have to test them for all 6 assertions. You may say, I'm going to test controls around existence because that'll save me time from sending so many AR confirmations. That's an option. Everything is thinking and speaking in terms of assertions, like Faba mentioned, like 6 hours ago, something like that. The other form that we have is then the actual planning and evaluation of the test. So again, 10.1, 10.2, testing controls. Now this is where it's a little bit duplicative. You either copy paste, you just refer to 10.1. Again, if I was Mr. PPC, I just make it one big form. But then the next part is really important. What's my population? Is it all checks throughout the year? Is it all timesheets throughout the year? And how do I know I got all of them? How do I know that the client didn't hold back anything that where the control wasn't performed? So I check begin date if it's all checks throughout the year, and I make sure if there's any gaps in there, it's probably void. Then I calculate my sample size, which comes directly from the slide that I just showed you. The slide that I showed you is right from the form. And usually I'll just see, they'll just highlight this in yellow or something and say, well, we were trying to lower control risk to moderate. It happens thousands of times this year, so we picked 25. It occurs 12 times a year. So in that case, we picked 2, 3, or 4. Pick a number. I don't care. How did you pick your sample? Just like you would in any other sample, haphazard, random, or systematic. Does it seem representative? Hopefully it does. Number of deviations? Hopefully it's 0 or less than whatever I expected. This is a one-stop shop for you to document. You're going to have the control testing on some Excel probably, but here's where you summarize it all. All I wanted to get out of that last 15 minutes is that you consider it as a team. If there's a cost benefit, do it. Again, the best practice slide for you to take with you. Determine the cost benefit. You don't have to test all 6 assertions. You can pick which assertions you want to test if that'll save you time at your end. If you do test the control, take credit for it. If you test control, that means your RMM goes down. You should do less work at your end. If you spend time testing controls and it doesn't save you any time at your end, something's flawed in your logic. So I just saved a little bit of time at the end to, sell it a little bit. It may not change anything you do, and that's perfectly fine. But I look at it, and what I'll leave you with before we break is you all spend so much time doing the minimum required for control work. Maybe it's just incremental, a little bit more, where you could test controls, certain controls, and it'll save you time at your end. But that has to happen during planning. It's not something that you'll accidentally figure out at 7 o'clock at night on March 10th in the heat of the audit. So we are at the top of the hour. We have our last break of the day. It's a 20-minute break. And then we'll come back and we'll spend our last 100 minutes talking about the bottom of the hourglass, analytics, scoping, sampling, programs, and wrap up. See you in 20 minutes. Thanks so much.
Great. It's the last one for today. So we're doing the final stretch. Now, the last section, we're going to talk about these further audit procedures and the wrap up, as Sean mentioned. Now, again, the learning objectives, we're going to go through some of those key forms. We're going to talk through some of the testing options. What are the key considerations related to them, analytical procedures? What do we do then when we find errors? How do we respond to them? And then talk about our wrap up, best practices, all of that. Again, as we're going through this final section, this is the section that theoretically is tying it all together. This is the part of the audit that most of us think about when we think we're doing an audit. The actual testing, the actual execution. All of the stuff that we've talked to until now is the setup, and we want to make sure we're giving that appropriate time. But when we think about the actual execution, this is the next step that we're going through. Now, this first polling question I'm just going to run here is just a quick, just to get us kind of an understanding of what is your firm doing? Does your firm do a great job modifying audit programs and customizing the steps with the scopes and client-specific information? The answer is being absolutely. We do all right, but we could do better. We take what we get and do those steps. So whatever is coming out of the template, or hey, did someone say Sally? So this was last year, or not sure, not really sure what we do related to this, but I'm eager to learn what are the options. So again, we have, I want to just, again, just for informational purposes, to see, it looks like there's quite a spread. You know, some folks saying, absolutely, yeah, we customize them. Others saying, you know what, we could do better. Or hey, we just take what's there within the form. And obviously, there's no right or wrong answer here, but we want to make sure that we, Sean and I have kind of said as much as all throughout, we want to customize. We want to make it unique to that client, because in order to effectively address those risks, all up to this, our next slide here, I believe, is that, sorry about that. My slide just jumped back. 1 second. There you go. Thanks, Sean. I was like, oh, my screen was freezing up on me. I appreciate that. So we go through and we want to customize as much as possible. We want to make sure that this is responding to the specific risks we have identified. We went through, we gained an understanding of the client. We went through, had our team meeting. We didn't really talk about that too much, but you know, we fine-tuned, we agreed upon the risk. We've gone through those CX7 series work papers and identify the specific risks, identify if there's a significant or fraud risks. We've gone through all of that. Then to go into this next step and not actually customize our procedures in order to address all the work we've done here, we've done ourselves a disservice. So we want to make sure we're customizing as much as possible. We're modeling our execution of the audit to respond to the specific items we've identified in these previous steps. That's why so much of the time is spent in this first half of the hourglass, that when it comes down to here, we're just, hey, we have our audit steps, we're going to execute them. We're going to respond to those specific risks that we've identified. This is, you've probably seen this pretty frequently, kind of the scales of justice. And essentially, this goes back to that audit risk model that Sean was talking about. So we said AR equals RMM times DR, right? So that RMM is made up of the inherent and control risk. But here is basically where we determine what we need to do in order to respond to those risks. Our goal is that these would be equal. Now this, especially as Sean said, kind of the arrogance of our profession, we're taking a bunch of letters, putting it together and saying, hey, we can make this scale balance, right? So it's a little bit of an art. How do we design these procedures to balance out these risks? Now, these risks aren't, hey, I have a number, $50, and I need to put 50 over here to balance it, right? It's a specific risk that we've identified. It's intangible, but what do we do in order to address that risk, whether it's management override or valuation concern or in AR write-offs, whatever it may be, the risks that we've identified, how do we ensure that we have a procedure that will address that risk? If we've identified control risks, hey, they don't have segregation of duties, how do we ensure we've designed a procedure to appropriately address that? Because at the end of the day, we need to get our audit risk to low. We need to get the scale to balance so that everything that we've identified has been appropriately addressed in our procedures. Now, the templates provide a great starting point, and I'm not saying that they don't. You know, all of our checklists, everything else create a great starting point, but they can't be as comprehensive as we need because every client's going to be a little bit different. Every industry is different, and there's no methodology out there that can say, hey, here's plug and play for every situation that you're going to run into, every industry, every client. So what we want to make sure, again, as Sean mentioned and I mentioned earlier, is that linkage. There's a clear linkage between what we understood about the entity, what we did in our risk assessment, and how that flows into our further audit procedures. So if we've gone through and said, we have concerns related to AR, we have concerns related to their incentive compensation program, we have other specific items we've identified. What procedures have we designed? What I saw consistently with teams when I did internal inspections and even reviewing is we get to a good spot here, and then we don't flow it through. We don't design, we don't customize our audit procedures to sufficiently respond to that risk. And kind of Sean mentioned in the previous method, think of the end in mind. What are we concerned about? How do we need to design those procedures in order to effectively address it? Now, this is another concept we've talked about, and something that those of you who are familiar with auditing have seen a million times: the nature, the timing, and the extent. This is how we do our audit, how we customize our procedures. So the nature of our test, what kind of test is most appropriate to address this assertion? What kind of test is most appropriate? Sometimes it could be an analytic, sometimes we're detailed testing, and we'll go through that tree in just a second in a couple slides. But what makes the most sense? What is most appropriate for this specific risk that we're identifying? And when do we do it? Do we do it at an interim period? Do we do it at year end? Do we do it 6 months after year end, 3 months after year end? How do we time this test? There are certain tests that we have to do at a specific time. Inventory observation being one. We have to do it at year end. If we don't do it at year end, we have to do additional steps in order to remedy the fact that we're unable to do it at year end. What is the extent of our testing? How much testing do we need to do in order to effectively address this risk, to make sure that we get to, limit it? We get to that limited error. We've identified those material misstatements effectively, and we haven't left an untested balance out there, or a significant balance that didn't have the appropriate attention or the risks identified and addressed. So again, we'll go through this in just a bit. The biggest thing I want to drive home here is that the nature is the most important aspect of this. Because if the type of test you're doing is not appropriately designed, it doesn't matter when you did it or how much you did it, because your test didn't address the assertion you were trying to hit. If you were trying to do a completeness test and you were sampling the population, you may not effectively address that assertion with that test. No matter how well you design it, you're going to have an issue because the nature doesn't address the assertion. So again, just thinking about that, knowing that we need to design which test before we figure out the remaining two aspects here of the little net that we talk about when we talk about audit programs. So this one here is another polling question. Are you designing procedures to test AR existence assertion for the to test the existence assertion for AR? GAS requires that you confirm AR, but you would like to reduce the number of confirmations. Which of the following statements is not true? So A is, I can test the operating effectiveness of key controls over the existence assertion to reduce the number of confirmations. B, I can test AR existence with substantive analytics first. C, I can choose based on a scope or judgmental rather than sampling. Or D, it's not my decision, I must sample. So which of the following is not true? So gas requires that we do send AR confirmations. And again, this is an area that in some industries is very difficult. So what can we do to kind of mitigate those, the number of required confirmations? Go ahead and end that quiz. So over half, a majority of you has got the right answer. The incorrect one there would be, hey, it's not my decision, because we have the ability to test operating effectiveness. We can use analytics and other tests to reduce the required number. And we'll walk through the sampling. We'll walk through the sampling template and see how those factors come into play. And we can also, hey, use a scope, use judgmental selections in order to reduce our sampling requirement. Again, we're going to go through and see how much work do we need to do to effectively address the risks that we have, to ensure that we don't have an untested balance, or there isn't a material misstatement somewhere in our untested area that we haven't addressed. Many of you are probably familiar with this tree here. This is, once we get through the audit process, we get down to further audit procedures. Sean kind of talked about testing of internal controls. I would tell you in my experience, we didn't do this very often either. We probably should have more often than we did. There are definitely opportunities there, but many times we're like, hey, we don't do internal control testing, and my clients, it just wasn't effective. There were a handful where we were able to. When you have large volumes, frequent transactions, hey, if you're able to test one assertions and reduce your testing significantly related to existence or whatever it may be, it may significantly reduce. But I would say, honestly, we definitely didn't take that opportunity as much as we could have. Once you get down, the next step there is substantive testing. So what are the options? Analytical procedures or detailed testing. Now, I encourage you always, and I think this is something as Audit Watch we've always consistently say throughout our curriculum, is think analytically first. So is there an opportunity to design an analytic to effectively address this? Especially today where we work with a ton of data. Our clients have strong databases that we can data mine and go through. We can gather a lot of valuable information that we may not capture if we've gone that true detailed testing route. And there's also certain assertions that just lend themselves to analytical procedures better than detailed testing. So always when we're going through and designing procedures, we're determining what makes the most sense. Think about, hey, can an analytical procedure get me to the same spot? Will it effectively address this assertion, this risk? Because it can give us it potentially can give us a much more comprehensive view of a specific audit area, especially when you're talking about large volumes, income statement accounts, things like that. Analytical procedures just tend to be stronger than sampling detailed testing for specific assertions. If we're going down the detailed testing route, now we have a couple options. We could do what we call individually significant items. So ISI items, right? You set an ISI, you determine whether it's a scope or, hey, I think we have specific risks related to this specific division, or, hey, this customer has, slow in paying, so we have valuation concerns related to them, so we judgmentally selected that. Or, hey, we're doing a vacation accruals or bonus accruals, and we know that because there's a new incentive plan, bonuses for the controller and up could be manipulated in any way. So we've identified a specific risk and we've decided to judgmentally select that, or we set a scope and say, hey, everything above, $50,000, I'm going to make those selections. The other option is to go the sampling route. And you could end up with a combination of these factors too. You may end up, hey, I have some individually significant items for an area and the remaining untested balance, I'm going to sample it. We're going to talk about different types of sampling, statistical versus non-statistical. I will say the large majority of my personal experience, I ended up in the non-statistical side of it. That being said, with the advances in new technology, statistical sampling may become more prevalent within the industries just because it's, with technologies available, data mining software is available, you could go down the statistical sampling route a little bit easier than manually doing it through Excel like I did when I was coming through the ranks. I'm going to skip the polling question. The biggest thing here is which of these is not one of the primary actions that you work on when you talk about PPC forms. And here it's just do it. We shouldn't just do it. We shouldn't just follow the program just as it is. You really want to make sure you're adding, deleting, modifying, making sure it's focused at your client. So if they have a specific type of report, we've incorporated that. If they look at their reserves a certain way, we've incorporated that language into our steps.
And I put this in here just to generate some conversation because unfortunately, I do see a lot of firms that think B is the best answer. And I get into some pretty passionate discussions at times where a team will say, this is what Checkpoint Engage or Smart or PPC gave me. So I'm doing all the steps. I'm not adding any and I'm not taking any away. And I'm like, again, we're not looking for robots. The goal is that it's a starting program. And Faba's next slide is going to really get into what you're supposed to do with that starting program. Simply put, it's turn your brain on and make the best decision for where you're supposed to go with that starting program.
Absolutely. So all the audit programs are going to be generic. Again, this is a methodology that's supposed to address a wide range of industries. As Sean mentioned in the top of the class, this is designed for top 50 firms, sole proprietors, all using the same methodology. The audit programs are designed to address that. So the clients at a top 50 firm versus a sole proprietor is addressing are wildly different. Addressing a Fortune 500 company and a mom and pop shop going to be wildly different. So we want to make sure that we are adding the procedures that you need, deleting the procedures that you are not appropriate, and modifying the wording appropriately. We want to prioritize and making sure that we're getting the best bang for our buck. At the end of the day, we charge, whether it's a flat fee or hourly, we calculate a realization. We go through and say, this is how much our team's time is valued at. And we want to maximize that by ensuring that our team is working on the things that are important. And Sean kind of mentioned this earlier today, sometimes that means sometimes that means reordering it. Yes, everything on the program should be done, absolutely. But there are certain things that we want our team to tackle first. If we think valuation is an issue, maybe we move that program step to the first one because we want our team to address that first. So really customize it to what are the risks and concerns. Obviously, we need to do everything that the standards require, but in order to effectively do that, the standards essentially give you the ability to have auditor judgment at the end of the day, that key that we keep talking about to design your procedures effectively to address those risks. The standards don't give you step-by-step what we're going to do. So now we're going to talk about analytical procedures when they're appropriate. Again, I am a big fan of analytical procedures, and especially just even in the progression of my career, when I started out of college to now, the availability of information and data is infinitely better than what when I first started in public accounting. And so we're able to leverage analytical procedures much better now than when I started. And I think that that's just going to infinitely grow as our clients become more technologically savvy. So when do we use substantive analytical procedures? Obviously, in review engagements, it's our primary work. But in the framework of an audit, The most important areas, again, large volumes of transactions where it's predictable over time, or there's intercorrelation. We can identify causality. Examples, for example, payroll, depreciation, right? Interest. All of those are predictable over time. Generally, income statement accounts. That being said, it's not that the balance sheet is excluded from analytical procedures. You may have prepaid expenses, accrued expenses, all that can be done analytically, but definitely the income statement. You can leverage analytical procedures in that environment. Many times analytical procedures are a more efficient way to address completeness and specific assertions. And when we combine them with other tests, we can reduce our testing. So when we combine it for AR testing, when we combine analytical procedures and detailed testing, we can actually reduce our sample population. We'll go through the sampling template to show you that, but in conjunction, we don't have to necessarily test a balance one way. We can use a combination of several tests in order to effectively address a balance. So maybe we look at ISI items for a specific balance and then analytically do the remaining population. We have to determine what makes sense for each balance and what the risks are, but we want to always think analytically first. Make sure that we are identifying the appropriate procedure, and if there's a way to do it analytically, effectively and efficiently, we should try it. There are obviously opportunities where detailed testing is just more effective, more efficient, and in those environments, absolutely, we need to do that. I just caution, it's easy for us as auditors to be like, hey, the invoice, it's just easy to detail test. We default to our sampling. I know I did as an auditor, right? It's just easy. If I can just get a handle of a couple invoices, I'd much rather do that than try to design this analytical procedure. But me getting a hand on a couple invoices may not be the most effective way to test that population. And those specific invoices may not be representative of the population. Whereas an analytic may be able to give you a much better comprehensive view. So this one, again, is another polling question that we have. It says the following factors would drive payroll expense in the current year compared to prior years. So again, this is just setting up the example that we're going to walk through. So the number of employees, the raises or pay freezes, cuts that we have, one-time bonuses, D, all of the above, or E, none of the above. So this is going to be, thanks, Sean, for launching that for me. So go ahead and pick which one of these would impact our payroll expense. So then we're going to talk through an example of different things that I see. These examples are ones that I've seen consistently in my career. So which of these would drive payroll expense for the current year compared to the prior year? So is it number of employees, pay raises, freezes, cuts, one-time bonuses, all of the above, none of the above? Looks like the large majority of you have gotten the right answer. I'm going to go ahead and end this quiz. But I would definitely say all of the above here would impact payroll expense, right? But I consistently see, and I will say, this is an analytic that I've consistently seen. And Sean, I'm sure you have a million times as well. Hey, year over year, change is less than 5%. Companies similar to prior year, the increase is just related to raises, seems reasonable. And call it a day. This is all that was done. And this balance, especially if you have a not-for-profit, you have some industry, this could be the largest balance on your income statement in the expenses. And this is all we did. Now, what is the problem with this is, what is similar? How do we define similar? What is slight? How do we define slight? Was that a raise for all the people? Was the raise 5%, did folks get 10%? Then is that change appropriate? Was it, did all the bonuses and raises go into effect in November, or did they go into effect in January? At what point did we see this change? We want to make sure that we are addressing all of the factors that are changing. Now, this next slide, we're going to see a much more robust audit analytic. Here, we've taken the prior year salaries, we've determined the number of employees, we've determined, hey, this is the current year raise that was given. We've determined the number of current year employees and calculated an expectation. The biggest thing about analytics is making sure that we've created a strong expectation going in. I've consistently seen, and this is from prelim analytics all the way through the end, a lot of times we look at the answer and then formulate our response. Hey, AR went up $2,000. There was a slight increase from the prior year, seems reasonable. Whenever I see documentation like that, I know you cheated. I know you went through and determined what the change was and then fit a narrative to match that. Here, if in a strong analytic, we've designed and we've created. Now, could there be other factors in here? Could there be bonuses? All of that? Absolutely. And we may need to take those and, everybody received a $1,000 Christmas bonus, whatever it may be. We want to make sure we're capturing those changes before we go through and compare to our actual. So we've now here defined an expectation. We compared that to our actual, and then we come up with a difference. Now, we're going to talk about the significant difference threshold in a little bit, but and we've kind of highlighted it in the past, but essentially we're saying if it's below the $75,000, we think, hey, that it's reasonable. The change is reasonable. We're going to set, and sometimes for an analytic, very rarely, I would say, and Sean, you can correct me if I'm, we typically put a threshold that's going to be above trivial here, because trivial, it may be appropriate for other testing areas, and it could be trivial here. If we say, hey, the difference is below trivial, you pass on it, you may be done as well. Sometimes I've seen a higher threshold utilized because we're saying, hey, this is maybe a lower risk area, something like that, and a higher threshold is utilized. The goal here is you want to make sure that it's enough below PM and that we're not going to land at a material misstatement. But essentially, we've gotten a much stronger analytic going through this process than we did in our previous slide, where we said, hey, year over year, it's pretty consistent. Nothing has changed. Now, assume we had the same numbers at the end of the day, but we saw, last year, 74 employees, and now this is 65. Then we have other considerations that we need to take. Hey, how did you land? But if we had just done the first test and said, hey, they had a decrease in some employees, but the raises offset it, the change is reasonable. I've seen that as well. If we don't go through this process and determine, hey, that average employee amount, how do we land on this? How do we know what our expectation is? If we don't go through that process, there's a chance we may not identify an issue that does exist. So going through, if anybody has questions on this, feel free to jump in and put them in the chat or say them and come off mute and say them. But essentially, we want to make sure we're designing our procedures effectively to address that. So these are just some key items for a great analytic. We want to always make sure that the analytic is suitable. Sometimes we want to make sure we're understanding causality. Sometimes things look related when they're really not. So, or a balance may not lend itself to be addressed analytically. We want to make sure that it's suitable. We want to make sure we understand the causality. And here, I always do this with, hey, because this happened, I expect X to happen. So because they had an increase in sales by 2%, I expect inventory costs to also increase by 2%. The other one is since they laid off 10 employees, we expect payroll to go back down by X percentage or X dollars. I always like to speak in dollars over percentages because I think it's easier to quantify, easier to understand, and then really peg against our materiality numbers and say, hey, is this appropriate? So we want to say we expect a drop in $10,000. That makes more sense. It's easier to understand than, hey, we expect a 2% change in this balance, whatever it may be. We want to understand the underlying data. We want to make sure that it's predictive and quantified, and it's used for corroboration. So all of those items, the things that we talked about throughout this process, we can corroborate various parts of our or check what our client is saying through our inquiry through various analytics and say, hey, they said it went up by this. We can check that through analytics and corroborate statements. So these are just some key items on analytics. Now, this is a form. Again, I'm going to share it on my screen. I'm just going to pull it up. And Sean, if you have anything to add while I pull up this form, feel free to jump in.
I agree with everything you said. I think that when you're setting, there's no definitive guidance in the standards, nor in PPC that says what thresholds you should set. I think it's fair to say it comes down to risk and materiality. The lower the risk, the closer to performance materiality. So as an example, prepaid expenses, low risk, you may say, this year to last year, my expectation based on what the client told me is the balance should be the same. As long as it hasn't moved by up to materiality, I'm done. I've moved on. You can use 50%, 75%. I don't love going less than 1/3. I think then you start really nitpicking things, and if it's high risk, if it's a high risk account, you might balance that with some detailed testing anyway. So I think I was in full agreement with the way you described it.
Absolutely. So this is the CX 9.1 form. So this is a substantive analytic work paper. Again, not a required work paper, but I will say this is a great guide to walk you through. So many times, at least in my career, a lot of our analytical work papers were built off client-provided data, client-provided spreadsheets. We built it into those. So we don't necessarily have to then migrate all of that information into this work paper. But what I will say this work paper does is forces you to think through the process of an analytic in the right order. So one, we describe the analytic, we go through and test or determine if it's the reliability of it, of the data, et cetera. We're going to test the assurance level that we need, whether it's high, moderate, or low. And then we're going to talk through the effectiveness of the test. We're going to talk through the expected amount. We're going to go through what we expect the results to be, and then compare against what actually happened. If there is a difference, what is that? What triggers that difference? If you go back to the standards say that if you effectively design your expectation and you've effectively designed your analytic, then any deviation from that expectation is indicative of an error or misstatement. So if we've effectively designed and we've gone through and built out our expectation appropriately, and we've built out our test well, any error, any difference that comes out, if it's material, is indicative of some sort of error. Now, you're always going to have minor, you may have small variances, and that is completely appropriate because we're not getting down to the dollar on everything. And as accountants and auditors, sometimes auditors probably easier. We love our materiality numbers and say, hey, it's a material. But as accountants, we really want to go down to it. Analytics don't lend themselves to that as much. But if we build it out properly, we establish those expectations, we can get pretty darn close. And then we go through and say, is that satisfactory or unsatisfactory? Do we need to do more, or did we do enough? Did we effectively explain and understand those why that variance existed, et cetera, and how to address that. Now, with an analytic, if you've come up with a material error, you're going to have to go back to the client and push them and say, hey, so this is what we're coming back with. What does that mean? Now, some analytics, when I worked on not-for-profit and we were talking about table sales for a gala event, and we're talking about gala revenue, right? That one will say, hey, we know the exact number of tables that were sold at the exact levels, and if that's not matching up, there's something wrong, either in their record keeping or and many times it was, hey, we gave away a couple tables for free. We had some promotional items, we had some sponsor tables, things like that we have to make sure that we're capturing. But others require more digging in, and maybe you end up saying, hey, client, you need to go figure this out, and then maybe we can't test it analytically anymore. Maybe we need to reassess our plan. So going back to this, so then we'll jump off this slide. The best practice for analytical procedures, at the end of the day, we want to make sure we are establishing expectations with causality. We want to make sure we understand the precision, how much testing we need to do. Now, those of you who might go through AutoWatch University or various other classes, we spend quite a bit of time talking about the precision of our tests. How much work do we need to do at various levels? So whether it be a low risk area versus a high risk area, what level of precision do we need to get to be comfortable? As Sean mentioned, if you're doing prepaid insurance, maybe you're okay with the larger variance because, hey, it's a low risk area. It's not known, historically we don't have any errors. I'm okay with kind of if it's off a little bit more, versus maybe if my allowance or something else that I'm looking at analytically is off. Maybe there are other implications. Maybe it's a number that goes into a debt covenant calculation or something like that, where we need our precision to be a little bit closer. We want to also make sure, any predictions we have, we've determined that significant threshold. Don't chase down any immaterial differences. Don't get caught up in the exercise. If it's below that threshold that you've determined, stop and move on. It's very easy to kind of get caught up trying to define and determine why something is not necessarily exactly what you expected it to be. Ensure that things are accurate and complete. We talked about VAC earlier in part 2. Make sure that the data that you're obtaining is valid, accurate, and complete, so that when you're building your analytic off of it, that you're working with good information. If you end up, and I can't tell you how many times I've been on engagements where the staff was like, hey, I went and did all this work, but nothing's making sense. And we find out, hey, you're using the AR aging from February instead of December. It's not the right information. Making sure that you have all that, or hey, it's missing 2 of these subsidiaries that it was supposed to include. Again, working in private equity, I had clients that had 15, 20 subsidiaries, and they would run a report. They'd say it's all inclusive. And then when we go through and push back on it, we're like, hey, you're missing these 2 codes. And therefore our analytics aren't popping out correctly. Making sure we do that, ensuring that's valid, accurate, and complete before we go through that analytic. Corroborate those inputs, making sure we have answers from the client, and turn on your brain. Make sure that we're using our brain when we design these procedures, when we walk through. Effective. At the end of the day, we want to be efficient and effective. Analytics can create a more efficient process, but at the end of the day, we want to make sure we don't get caught up in the process.
And I think based on that, Faber, again, you heard me earlier, I'm a big start with the end in mind guy. Our ultimate conclusion is that this balance is materially reasonable. That's our conclusion. So these don't have to be perfect. That's why we're able to set a significant difference threshold. It just has to be close enough for me to make that conclusion. And that threshold's ultimately going to be based on materiality and risk. So that's what makes it very efficient. If we go down these rabbit holes and we're trying to get this to work out to the dollar, it's going to take forever, and we probably would have been better off just scoping or sampling it instead of doing an analytic. So they're great procedures, but You got to take everything she just talked about and build that and make them good analytics instead of backing into the answer. That's when you get in trouble. We've all done it. So
this next thing we're going to do is run through this quiz. When your team does detailed testing, which of the following do you use? Do you use ISIs? Do you scope through ISIs? Do you sample? Do you do a combination of scope and sample? Look, I do what my boss tells me to do. Hey, which is, there have been times in my career which I've definitely done that. Or, hey, I don't know. I'm not sure what our firm does. But which of the following do you use? When you use detailed testing, do you use a combination or you do primarily one or the other? Awesome. So it looks like most folks do use some sort of combination of the sampling and scoping. And that's consistent with my experience as well. When we go through that second arm, so now we've talked about analytical procedures. When we go through that second arm of substantive testing, we have the option to use individual scoping, judgmental selections, or sampling. And again, in many times, as you guys have all indicated, we may do a combination of it. So when we do a scope test, we are determining there is a specific threshold, dollar value, or risk that we want to utilize to capture a balance. So we may go through and say, hey, I want selections, individually significant items over $50,000 or $150,000, or items that are coded a certain way, that have a specific risk factor, and I want to test those. Once we've pulled those out, and I'm going to walk us through the 8.1 form, we're going to go back and determine, hey, once I pull those out, these are tested at 100%, unlike a sample where we would be looking at, hey, this is one of a million, 10,000 records or whatever it may be. These items, we're saying 100% of the items that fit these characteristics, whether it's dollar value, risk, whatever we determine it to be, we're going to test it. Any error that we've identified there is a known error. We know exactly what is wrong if we identify an error. Versus in sampling, we're going to project an error. We're going to extrapolate an error. We're going to talk about that in just a second. But many times what I've seen teams do is, hey, you go through, you get to an ISI number, you pick something, but then your untested balance is still greater than PM. Well, we can't stop there. We have to do something else. That could mean that we're sampling the population. That could mean we're doing analytical procedures. Many times it could be a combination of the two, but essentially we want to make sure that we don't just stop. If that untested population is a material number, that we're doing something more. So I'm going to pull up this next form here.
And while you're doing that, Faba, the one thing for those of you that are migrating to Checkpoint Engage, what they've done in Checkpoint Engage with the advancements in technology, the CX 8.1 and the CX 8.2, which are going to be the two forms that Faba shows, they've merged into one form in Checkpoint Engage. I wish they'd do it in Excel and PPC as well, but they haven't yet. But they're now, I refer to them as the CX8 series. Right or wrong, that's what I call it. I don't know. But it's all one big form now in Checkpoint Engage, which is really cool, actually. I think it's a really nice change to make it a little bit easier for those of you doing scoping and sampling using Engage. If you're still using Smart or the Excel tools, it's going to look just like she's showing it here. Same exact form, it's just same inputs, it's just going to look a little bit different in Checkpoint Engage and be combined into one. So it'll just look different, but it's going to be exactly what she shows here.
And Sean, correct me if I'm wrong, I believe that if you know that you're going to end up sampling regardless, there's a chance that you might not even use the 8.1 form.
That is accurate. That is accurate in PPC and Smart. In Checkpoint Engage, it's all the same now.
Yeah,
so you're just going to use the same one. But
so
that is accurate.
So yeah, if you're using the paper forms or if you're in Smart, there's a chance that you might not use this. Only if you already know your conclusion. Hey, if you already know you're going to be sampling. Again, in the combined form and Engage, you're going to walk through this. And I personally, I like this because I think it forces you through a thought process. So this initial screen here, let me just make it a little bit bigger. So it goes through that initial calculation. It goes through and identifies what's my account balance. And this should have some sort of cross-reference to, you know, work paper, TB, whatever it may be. You should be cross-referencing that to a source. What I find a lot of times teams do is we're not necessarily addressing that balance appropriately. So, hey, we're going to test trade AR, but that's not all of AR. So make sure that you're capturing the appropriate line item that we're referencing here. Then you're going to go through and you're going to pull down your individually significant items. So we've determined, hey, any items above $100,000, we pulled those two out. And we're going to say, all right, so now we have a remaining population. So compare that remaining population to our tolerable misstatement. The directions here say that if the D, or if D is greater than E, we're not done. We need to go on and do more. So what that lends itself to is actually, first step is if it's lower, right? If we've determined this is $100,000, tolerable misstatement is $200,000, no further testing may be needed. But in this example specifically, our remaining balance is $1.6 million. Our tolerable misstatement is $200,000. So what do? Do we apply analytical procedures? Will that be sufficient? Are we relying on other substantive procedures? Are we sampling, or are we testing more individually significant items? Many times when it's that much of a differential, you might end up on the sampling. Hey, there's more than 200 items. We understand an expected misstatement. You know, we know what that process is. This is going to lead us to that 8.2 work paper that Sean was mentioning. We're going to document the results. We're going to go through and determine, hey, this is the population, the unusual items, the remaining balance, the tolerable misstatement. So that kind of summarizes back up. And then this last process here goes through the summary. So let me pull up the other form so you can kind of, for continuity's sake, see the next form that we'd fill out, the 8.2. Again, I apologize for that being so small. Let me get that a little bit bigger. So again, the same facts and circumstances. This is kind of repetitive, and as Sean mentioned, one of the perks of in Checkpoint Engage, them combining the form, is it removes some of that redundancy in carrying between the two forms. But then we've gone through and said, hey, these are the items we've individually pulled out. This is the remaining population to be sampled, and we go through and talk through the sampling. So we say, what is the sampling unit? Now, we haven't covered this yet, but many times, in my personal opinion, we should go to that lowest denominator. So that invoice level, I tend to lean away significantly from account balances. And when we jump back to the slides, I'll talk a little bit more about that. But we're going back to that customer invoice level. We're going to make selections of those invoices and test them individually for our detailed testing. This then goes through, how is completeness of the population considered? How do we know that our report that we're using has VAC? It's valid, accurate, and complete. What is a misstatement? So is a misstatement, not returned confirmations, or that return confirmation doesn't agree? What results in a deviation? We're going to go through and calculate our 1/3 of tolerable misstatement, what our expected error is supposed to be. Again, I would highly encourage, I've seen teams put 0 here, and I would argue that it's very difficult to conclude appropriately at the end of this form if you put 0 here, or say that the expected misstatement is supposed to be none, because at the end of the day, it says, is the sample appropriate? Any deviation, even if it's immaterial, if you say 0 up at that top, would say that the sample has failed. The real thing we need to understand about sampling is it's a pass-fail test. So when we go to sampling of any balance, it's either yes, it's good, or no, it's not. There's no degree of deviation. Now, if we say, these are the errors we identified and it's immaterial, that's a pass. If we end up with a factual and projected misstatement above the threshold we've determined, so we said above that $40,000, we end up at $60,000, for example, then it's a fail, and we have to determine what we need to do. We can't, and I've seen teams fall into this many times, say, oh, that's an isolated individual error. That happens so many times in my career. I've seen it so many. How do you know it's in an isolated individual career? You're sampling a population, and in this questionnaire, it says, is that sample population representative of the population? And we're going to say yes. Is the sampling risk acceptable? We say yes. We're going to go through all of that, and we want to justify our rationale. It's going to be very important that we don't just check a box. So again, this is kind of I kind of led into this, but why is it important that we don't use customer balances? The biggest thing is, if we're sending an AR confirmation and we send an AR confirmation to a specific customer and that balance has maybe 100 invoices, if we don't get that back, that means we're testing 100 invoices. We can't sample a sample. We can't say, oh, the confirmation didn't come back, so we're going to pick 10 of the 100 invoices and check it. No, you have to test all 100. Now, if you remember back on our sampling form, it doesn't say you need to test. It says, hey, your sample size is 66. Whether you choose to do balances or invoices, your sample unit is still 66. So if we decide to pick 66 invoices, you'll land far lower when you go the invoice route than you would if you do the balance route. And so that's the risk you take when you do balances. That being said, when I worked in not-for-profits and such, when we were confirming with agencies and things, it was much easier to confirm balances because that's how they reported it. They give us a bulk. Hey, this was the total disbursements for the year. They ran a report. They gave it to us. So if you know your client, you know what you're going to get, you know what the end result is. Maybe you can lean in our balances, but 90% of the time, I want to say I would argue for the invoices. That detail level is going to be super important so that we don't end up signing ourselves up for more testing than we need to. Again, we talked about this. I kind of mentioned this while we were on the form. At the end of the day, sampling is pass-fail. So we want to make sure that any errors that we find, we're testing less than 100%. So those ISI items, we tested at 100%, right? But anything we've sampled, we're not testing 100%. So we need to project our error. We're going to say, hey, we had 3% error in our sample. That means there's 3% error in our population because we're saying our sample is representative of the population. We project those errors over the population and determine if it's acceptable or it's rejected. If it's rejected, we got to do something else. If that variance is above PM, we're going to have to do something else. We haven't met the standard. We haven't gone through and addressed our risk. The key things here when we're doing substantive things, we want to make sure we're being very precise on what the objective is, what the population is, and what the sampling unit is. The important thing here is we want to make sure we have a comprehensive population and effectively identified the sampling unit. Now, when I worked in consumer goods and we were dealing with Macy's and such, the invoices were at like, hey, product by product, they had an invoice. So if they were doing a shipment for May, they could have 4,000 invoices associated with one shipment. And Macy's and no bill of lading was going to effectively capture that. So we needed to make sure we understood what sampling unit we used before we went through our sample. The other thing we want to make sure is you go through, you calculate that sample size. You choose a method of sampling, selecting items. So I didn't show this on the slide itself, but there is an option for whether you're going to do it randomly, you're going to do it haphazardly, or you're going to do it systematically. So which method you're going to do. If you're doing it, I find it hard. Truly random individually, it'd be very difficult for us to truly randomly select if we're just going through and picking. There's always some level of bias. If you're using some sort of software, something like that, you're able to create a random sample, whether it's, you have a seed number and it calculates, hey, these are the samples that you have. But going through and determining how you're going to select those items to make sure that they're representative. If you do systematic, you're saying, hey, I'm picking every X item. Every 10th item is going to be on my selections. And then evaluate those results. Determine if the sampling risk is appropriate. Determine if you're done or if you need to do more. So we talked through, I showed you the CX 8.2 form earlier when you were going through 8.1 and 8.2. Again, if you're in Checkpoint Engage, this is all going to be one form. In the 8 series forms that'll walk one into the other. So some of those best practices when it comes to scoping and sampling, we want to make sure we determine what our ISI and what our scopes will be early. Why is that important? Because it's going to impact how we then proceed with our test. If we have a remaining balance that we need to sample further, if we have analytical procedures or other items that we can address, one of the things that is going to be important is, and I believe it's on that CX 8.2, is there other substantive risks? Let me just pull up the form real quick again. There's a little bit that I skipped over. 1 second.
While you're doing that, the one thing I want to touch on for overriding, especially those of you that are new to PPC, is that, I know this is really auditing in general, but coverage does not matter. So some of you might have gotten a little bit uptight whenever we said, we think you should pick invoices. If you're confirming AR, probably the best move is to confirm invoices. If they don't come back, it's easier to do alternative procedures. But when you do invoices, you don't get a lot of coverage over the balance. But coverage doesn't matter. As long as you keep the integrity of the sample. And what I mean by that is the integrity of the sample is that every item in the population has an equal chance of being picked, either haphazardly, randomly, or systematically. Every unit, every sampling unit, whether it's invoice or balance or person or dollar, inventory SKU, whatever you pick as your sampling unit, every one. One of the things you can see where Fabe just highlighted, there's not a choice there to pick judgmental. There's no such thing as judgmental sample. So every item has an equal chance of being picked. And if you're doing judgmental samples, go back to the audit tree that she showed, that means you're really scoping. That means you're really using judgment to pick certain items, which is fine, just can't call it sampling. And you don't extrapolate that then. It's getting carved out of the population. So that's a big piece. In my career, I worked for 2 different firms. First firm was all scoping. Pick the 10 largest this, pick this. But then when I switched firms, I went to a sampling firm. And I was really uptight. The very first engagement I did was a dental practice at the University of Pittsburgh. And my team ran a sample size using this form, and their sample size came out to 4. So I'm the reviewer. I'm a senior manager, so I'm panicking. I'm like, oh, we only tested 4 items. I don't think we did enough. Then I looked at the testing, and I don't know what they picked, floss or toothbrushes. It was some incredibly low dollar amount that they picked. And I'm like, oh, you only got 8% coverage. And I actually had a partner pull me aside. And he kind of actually pulled me in off the ledge and said, sit down, let me explain to you how sampling works. And it was, after 8-9 years in public accounting where we did almost all scoping, I didn't do a lot of sampling, so I didn't know these core concepts. Everyone has a chance of being picked. You don't invoke judgment, and you don't care about coverage. That was really difficult for me as I switched firms to live with, but I got over it.
And I will say, and Sean, I'm sure you've seen this in your career several times as well. I'd see a team that puts together a sample, and then somewhere in their documentation they'll be like, and with the sample, we got 74% coverage. And I was like, how did you land there? If you truly didn't produce any judgment, if you didn't have any bias in creating those selections, how did you land there?
See, Faye, but this is such the difference between you and me, because you said that so sweet. Meanwhile, when I see that, I immediately go, cheater. I know you cheated. You cheated on your sample because there's no way you got 74% coverage. I know you picked the big ones. I know you went, I'm going to take this one. Oh, $62. I meant this one, $22,000. It's obvious. You're right on. Those firms, the teams that document coverage, generally it's an indicator to me that they cheated. They picked the big ones. They picked the funny names. They picked places where their friends work. It's usually pretty obvious.
Yeah, and like even especially again, I had big box consumers, so we would have Macy's $10 invoice for Macy's, and that's what the sampling. We use a software to pick our sample, and that's what would kick out. And especially folks who grew up with the firm and had this familiarity with this client base was used to seeing that. But we would always get that manager, senior manager that would come in from another firm and be like, you picked a $10 invoice. What's wrong with you? Be like, everything has an equal chance. You got to be able to pick. Everything has an equal chance of being selected. So going through and really understanding that. So again, this goes through and says, how did I select it? Again, I think with softwares and things being more available, random and systematic are just becoming more prevalent. But I would say most of my career, we landed at the haphazard kind of default selection. Then when we go through this, when we're calculating our sample size, so again, we talked about tolerance statement, we talked about how we landed at some of these numbers. These next two things that we talked about, and checkpoint and gauge, these are kind of drop downs that you'll see. It's kind of calculated in the background. So that first risk of material misstatement, that's coming from your risk assessment forms. Here in the flat forms, you're picking it again, but in checkpoint and gauge, that automatically pulls and says, hey, you've determined for this assertion, risk of material misstatement is moderate. So it's going to pull that in. The other factor that's considered here is your other substantive procedures risk. So this says, we have other substantive substantive procedures such as analytics, something else that address this assertion. And that's what's important. Not that it addresses a different assertion. Specifically, if we're talking about existence, if we're sampling for existence, we have other procedures that address existence. And I would say, and I don't think in checkpoint and gauge you have the option to do this, but in the flat forms and in SMART, I would highly encourage you. You should put a reference right here that says, hey, this is where I did those other procedures that address this assertion. Now, if you're talking about AR, if your other procedures address valuation, and this test is for existence, we can't say this is low or moderate. We can't reduce it because those other tests that we did not address this specific assertion. That's going to be a key thing that we want to make sure we understand. We have other procedures that address this specific one. Go ahead, Sean.
I want to highlight what you said because I think it's a takeaway for the group. Well, it's going to be a takeaway, and I'm going to tell you that you have to find a way to do it. But where she has the box highlighted, if you're using SMART or PPC, you can type a cross-reference in here, see work paper, whatever, where a substantive analytical procedure was done. Up above, where it says moderate, you really should have a cross-reference to say see 7.1 form. In checkpoint and gauge, here's your pro and your con. In checkpoint and gauge, where it says moderate for RMM, that automatically gets linked to your 7.1 form as long as above you click the right account and the correct assertion. So again, speaking and thinking in terms of assertions. If we're sending confirmations, it's for existence. So you don't put valuation, don't put rights, it's existence, and it'll put it automatically in there. The con is in checkpoint engage, you have to pick low, moderate, or high for OSPR, other substantive procedures risk. In checkpoint engage, right now, there is not a box next to it to document how or why you got to moderate or low. I encourage you to find someplace on the form, find another text box that's available and document it there. The developers are aware of it. It's a bit of a hiccup because we want the products, we want what you're using to drive your behavior. Now, again, if I was Mr. PPC, I would probably highlight this box and say, in this box, please document a cross-reference. And you only need that if you move other substantive procedures risk to moderate or low. I say from a practical perspective, I think it's generally easy to get to moderate. You can do some fluxes, you can do some high-level analytics. I think it's generally difficult to get to low. You have to do some very robust, very strong analytics to get to low, because you don't want to get to low and have somebody disagree later. Because if she played with this form, as you go from high to moderate to low, you'll see the number changing. To go, if you said, I did really, really good analytics, therefore my sample size went from 19 to 10. If somebody after the fact says, you know what, those analytics were fine, but they weren't really, really good, you should have put moderate there. Then it's going to change it to somewhere 13 or 14, which then becomes, I didn't do enough work. I only tested 10. Now I'm in a pickle. So I encourage you, as you're doing this, those of you that are staff and seniors, you may want to get somebody to sign off on this before you make the effort to go pick your sample size. Managers and partners, you may want to invoke that as a policy. Anytime we're running a sample, I want to review it before you go crazy and run a random number generator to give me 13 items between 1 and X number. So love sampling, but if we botch something, or if we make a bad judgment, it gives us the wrong number to test, either good or bad, too many or too few. And it's always tough to fix it on the back end. So be careful there.
Absolutely. So when, again, what Sean was saying, that risk of material misstatement and other substantive procedures risk combination calculates that risk factor that's captured here. So this risk factor is a function of these two drop downs, and in checkpoint engage, again, it's going on in the background. And you're going to go through and calculate, and as Sean said, it substantially changes anywhere from 19 to 10. And the last thing you want to do is, as you're going through, your team calculates a sample and you're like, hey, how do we land here? I've had this occur where, we're in a rush. We don't look at it ahead of time. And then at the back end, we're like, hey, client, we have, 6 more selections we need to make. That's a hard conversation to have, especially when we're doing things remotely. So I transitioned to AutoWatch mid-pandemic or mid-responding to the pandemic. And when we were doing some of these audits remotely, it was very challenging because, hey, we have the client going to the office 1 day, 2 days a week to pull support and scan it to us or send it to us, mail it to us. If we then go back and say, hey, just kidding, we also need 5 more selections, it's just a harder conversation. Again, we want to avoid that rework. Try to get your managers, and if you are managers and partners on this, try to review this before an actual sample goes out the door so that we can catch those errors ahead of time.
Although I will say it's the better of the two discussions. I'd rather have that discussion with the client now than with a peer reviewer a year from now.
Absolutely.
Real quick, Fabe, if you can scroll up, I want to tie one thing together, and then maybe you can illustrate it in the risk factor table. Go up to 10A. Yeah. So remember, I want to tie together. We touched on briefly about testing controls. So if we're at RMM of moderate and our sample size is 19, but now let's move it to low. Let's say we tested controls and we were able to move it to low. It moves my sample size to 16. So I save 3. So then that's where the cost benefit comes in. How long did it take me to test controls to go from moderate to low? And did I save more time than saving 3 items? Probably not. But if my sample size was 100 versus 70, then maybe it would be worth it to test controls and move my risk from high to moderate, high to low, or moderate to low. So again, that's part of, I hate to use the word, but I'll say playing with the form to help us determine what's going to be our best option to test a certain assertion. If I can go from 100 to 70 confirmations by testing a control around existence, that's probably going to save me time, because you know what a pain it is to get accounts payable departments or customers or anybody to return confirmations, send seconds, then do alternative procedures and blah. You're like, I could have just tested controls and maybe cut out 30 of these. You may find that it's actually a cost savings.
Absolutely. And again, this goes back to, it's a little bit more of an art than a science or an exact math. You're going to have to figure out what makes sense. I've had a handful of clients in my career. Again, as I said, we didn't do control testing a lot, but a handful of clients where we substantially were able to decrease the amount of detailed testing we did by testing controls for a specific assertion. And again, if the frequency of that specific control is relatively small, maybe doing 4, 10, 20, you may substantially decrease what you have, and your combination of your control test and your test of detail in total will not exceed your total sample population area you would have been if this was high and high, or the combination of the two. So this goes through that risk factor table. Again, this next section asks about stratification. So again, if you do not stratify, it's a little bit punitive. You end up having to increase your population by 20%. You do stratify. Again, if you have a distinction between your sample, that's where you stratify. If your entire population is homogeneous, it's going to be very difficult to stratify. So if you have an upper and lower strata or something like that, you're able to stratify and then create the appropriate response to it. But again, the stratification really is, if you're not able to do that, there is going to be a multiplier that you need to increase by. So if I jump back to our slides, I believe, 1 second here. So we go through some of those best practices. We want to make sure that we avoid any sloppy errors, anything that wrong sample size, things like that. Again, making sure that our managers or partners, those of you who are involved, are looking at these before samples go out the door, and definitely concluding on it appropriately so that you don't end up in a situation with peer review. I was involved with some internal inspection processes, and one of the things that we consistently saw is, hey, you created sample size, but then the sample testing didn't match. We ended up having to replace the selection, and then we didn't clean up our work papers, or something happened. We want to make sure that there's no sloppy errors. Making sure that you have the right sampling unit. Again, as I mentioned, the leaning towards those invoices instead of balance is going to be important. Getting your information electronically in a way that we can sample. So again, early in my career, and I might be dating myself a little bit here, we used to I had clients who were a little bit more archaic in their systems, and they would give us like inventory reports were on like bar paper. And we're like, hey, so this is not super easy to manipulate and sample. We would have to figure out how to do that. We would, thankfully over time, more and more, we're able to get things in Excel or in a format we can convert into Excel. Getting that information electronically, creating, again, helps us ensure the validity, mathematical accuracy, all of that. Be careful with haphazard selections. Make sure that every item, as Sean mentioned, has an equal chance of being selected. Make sure you're not like, hey, oh, my random sample ended up at 62. I want a bigger item. Or I know that this used to happen a lot with our compliance testing. Be like, oh, this is a funky name. I want to have that. And I'm like, how did you end up with all of these? There's no way this was completely random. You want to know what you do when you find an error. So in a sample, you would extrapolate the error over the population. So if we've determined a $10,000 error in our sample, what does that mean for our population? Does that result in something material? Again, do not extrapolate scoped items. Anything we've pulled out judgmentally, we're testing at 100%. We would not push those items into the population. But any errors that we identify here, we would identify as known errors. Any extrapolated errors are likely. We don't typically book likely errors. I should say almost never book a likely error. We may book a known error, or it might go on the past adjustment sheet. We'll talk about that in just a second. But when you're extrapolating an error, you can't actually quantify that. It's not necessary. It's an estimation of an error. So, especially when you're doing AR, for example, for existence, you're going through and you're determining the value. You have a projected error. You wouldn't then go ahead and say, "Hey, client, I think your AR is understated by $50,000. Let's book additional $50,000 of revenue." That's not appropriate, or vice versa. However, for those scoped items, you've tested that at 100%. You know exactly what's wrong with it. And so you can book those errors. And then again, determining if you pass or fail, we're going to test against that accepted variance and say, compared to that accepted variance, is this appropriate? Is this test a pass or is it a fail? Now, any questions on this, again, feel free to throw them in the chat. Otherwise, we're going to jump to wrapping up the engagement. We have just about 20 minutes, a little under 20 minutes left, and then we'll talk through any questions that you may have regarding any of the things that we've talked about all day. No, it's been a long day. We've covered a ton of topics, but we really would love to hear your feedback and questions. So this next polling question I have, just going to run it here real quick, is you find an unrecorded liability in the search for $9,000, which is greater than your trivial amount of $3,000. What type of error should you communicate to the client? So again, you're going through that search, you determined an error of $9,000. What type of error should you communicate? Is this I would find something to offset it so that I don't have to talk to the client? B, factual. C, judgmental. D, projected. Again, which one of these would you do? It's like we have almost everyone answering. So again, someone's being honest. I'd find something to offset it. Obviously, this is a factual error. We've gone through the search, we've determined an item, and again, we've tested it 100%. We know exactly what's wrong with it. That's a factual error. A judgmental error, again, would be, hey, we went through a methodology in addressing an allowance. Your client went through a methodology in addressing the allowance. We have a difference. And so we've determined that difference is above the threshold that we think is acceptable. And so we have a judgmental difference. And then when we talked about sampling, that was that projected difference. Now, when it comes to the search for unrecorded liabilities, again, it's not necessarily appropriate to project your error over the population, because again, the nature of that test doesn't lend itself to project it. Because if you say, I went through and we've scoped X number of items, we said above a specific dollar value, 10,000, 50,000, whatever it may be, we've selected all those items. We've tested those at 100%. We're not sampling. Now, I have seen firms who've taken a sampling route to accruals and such. You want to make sure that you're very careful in which areas you're projecting that, because it might not be appropriate to project that error over a future population. Again, in this situation, factual would be the correct answer. So what do we do with misstatements that we identify? So we've gone through the audit process. We determined all of those items. Again, remember, those trivial items, we've waived them on the work paper. We're not going to focus on anything immaterial. We only want the ones that are above our trivial threshold that we accumulate, and we're going to accumulate them. We're going to evaluate them against materiality and determine, okay, based on our materiality, where does this land us? And then we're going to communicate. No client wants surprises. Whenever I went through an audit, the biggest thing that I would do, if we identified the error in a misstatement of any kind, I would communicate that to the client almost immediately and say, hey, we went through a test. We determined this error. That gives a client ability to kind of respond. Take into consideration anything that we may have missed. Maybe come back with, hey, I thought this, I've had a couple times where, hey, we identified this issue in this, we're going to project it out, but just FYI, this is what we found. And the client goes back and say, oh, you know what? Actually, I went back and did the analysis. We need to book another accrual because these were all items that we missed. It's more pervasive than what you thought it was. And I've had that happen too. So really communicating to the client is going to be very important. Now, have those accumulated adjustments captured and communicate that with management. So, and that sometimes, especially not-for-profits and stuff, that could include an audit chair, things like that, where you're communicating up, and then they're going to make a decision on things that they want to book, and anything that they don't want to book, we're going to put on our past adjustment sheet, and they're going to have to agree to it. Sometimes, hey, it gives us a little bit leverage because we're going to say, hey, this is going to be on a past adjustment sheet. You're going to have to sign off on it. We're going to present it at the board. Then they'll be like, you know what, forget it. Just book it. And they'll land at the same spot, and we'll get those errors pushed through. But you want to make sure you're understanding. The most important thing is anything that's projected or judgmental, you would really want to consider if an entry is required. Most times, because by the nature of those items, those errors, it's very difficult to pinpoint. Now, the client may be able to fine tune that and say, hey, we went back and we did an analysis. This is, the true corrected number, and we may book that, compare it against our testing results, and maybe it might be in line. But very rarely would we just take our projected error out of our testing and book that in. Anytime when we determine an error, especially if we see consistent errors, that's indicative of some sort of control deficiency. So if there is an error that's coming, we have to determine, is there a control deficiency? Is there a breakdown in internal controls that causes error to exist? So what happened that resulted in this error? Whether it's things weren't reconciled appropriately or timely, whether it's specific work wasn't done, or someone's not looking at it, or some threshold, something is not working correctly. Because if we have at the end of the day, the client's supposed to design procedures and controls to identify and correct material misstatements. If we're going through the audit process and we're finding things, that means something in their control environment is wrong. And then we're going to communicate that through a management letter or something along those lines. So when we're evaluating misstatements, we want to correct any factual misstatements. As I mentioned, we're going to go through and investigate any projected or judgmental ones, determine if an entry is appropriate. Otherwise, it might just remain on the past adjustment sheet. And I'll show you guys that in just a second. We have to consider individually or in an aggregate if those errors would materially misstate the financial statements. And there are some other things that we want to consider here. There may be some qualitative, quantitative items that we need to check. So for example, if they're borderline on a covenant, maybe that error that maybe historically may not have been a big deal is a big deal now because they would trip them into non-compliance. Those things are going to be factors when we're considering those misstatements that we find. We're going to look at prior period, any prior year adjustments that were passed. What is the impact on it? We're going to evaluate materiality and go through and book or pass on entries appropriately. So I'm going to pull up a form so you guys can kind of see. This is the 12.2 form. Just give me 1 second. Sorry, my shared desktop is freezing on me. Just give
All
me a
right,
second.
I have no bantering to add. That was very comprehensive. I was in agreement with all of it. The one thing that I will embellish a little bit is, I was there when the rules changed, and I love the fact that the rules changed such that if the client said, "I don't want to book that," then we're like, "Oh, that's fine, but I'm going to tell on you. I'm going to go tell the audit committee on you that you didn't want to book these. Oh, and by the way, I'm going to attach the listing to the rep letter. So you're going to have to sign it, and you're going to have to say that I recognize that these are adjustments that should be, we're electing not to make them." I love that change. I think I'm a little hung up on justice, and I wanted to have the last word. And it's not a positive trait of my personality, but it sure made me feel better whenever clients would just beat us up, especially after we filled out the 4.1 form under control environment and documented the client wants to do the right thing. They want the numbers to be right. Then 3 months later, we're fighting with them because they don't want to book an entry that is factually wrong. So I enjoyed that in my career.
Absolutely. And that's not unusual, right? I would get that consistently. We would go through the audit process and they're like, well, we've already calculated our incentive comps. Like, we've already done all of this. We want to do it. And then they're like, oh, but you're going to, all right, well, if you're going to tell them, if I have to sign off on it, then I might as well put it. And we end up fighting for, and then at the end of the day, we land at the same thing. So one of the things we wanted to make sure we bring up this audit difference evaluation form. So this, again, is capturing the cumulative effect of those entries. This is just an example that we went through and we said, hey, this is a factual error we found. We found 2 items in AP that were not correctly recorded. We captured the work paper reference, and then we're going to figure out what impact did it have. So this is where the negatives and positives, those credits, is important in filling out this form. We want to make sure what we're correctly capturing the impact to that category. So total liabilities, is it understated or overstated? What is the impact on working capital? What is the impact on equity? What is the impact on income before taxes? It goes through and calculates all of that. If you have income taxes, net income, what are those impacts? If we go down a little further, it goes through and says, okay, based on the prior year, what cumulative effects do you have of the iron curtain or the rollover, depending on if it was errors that we had in the last year, a cumulative roll of it, or flat for just this year. What is the cumulative effect? And then go through and say, what is the percentage? Then we're going to determine, hey, based on the results of this evaluation form and the qualitative factors that I mentioned, so that's going to be impacts to covenants, all of that, individually or in aggregate, do these cause financial statements to be materially misstated? And you're going to end up with this going through this form. Typically, if you have any error here, we would result in either a management letter comment or some internal control deficiency statement. So just be cautious there. And I know my previous firm, we had to put a work paper reference actually to the internal control deficiency evaluation form for every entry that said, is there a deficiency or not, and document appropriately. So, and that's something that I think is important to do. We do that here in this box below. So let me just stop sharing here, jump back to the slide.
I think the biggest things there is getting the signs correct between positives and negatives, and just following what the form says. I think the other thing, especially for those of you that are coming from RSM's methodology and using PPC's methodology for the first time, when you look at that 12.2 form, you will see on there at no point, I referred to this about 8 hours ago, I think, you'll see on there that at no point does it ask you what planning materiality was. At this point, you're just evaluating the uncorrected misstatements as a percentage of the financial statement line items or as a percentage of net income. So you could have an adjustment that's fairly small quantitatively, but if it's 50% of the bottom line, it could be well below planning materiality, but you're like, client, you got to book this. This is taking away half of your net income. And so you never go back. Once you execute the testing, you never go back to planning or performance materiality. At this point, we go to what we call evaluation materiality. In the true definition of materiality, what would a firm or what would a user think if we didn't book these entries? Would they change the way they look at these statements? And a lot of that's going to be those qualitative items at the bottom of the 12.2 form.
So then, absolutely. And then translating that, now we go to how do we communicate this? We make sure that, any errors are tagged with the management representation letter, that they're signing those together. Any communication with governance is appropriate, whether it's through management letter comments, through internal control deficiencies, all of that's effectively captured. We want to make sure that we've done the appropriate work. So how do we, in the 15.1 form, and I don't have it pulled up, but essentially this form will walk through those control deficiencies and go through and say, hey, so this is the deficiency we've identified. These are the classes that it impacts. What does it do? What financial assertion does it impact? And go through and say, is it a material weakness? Is it a significant deficiency or a control deficiency? And then what are we doing with it? We're, whether it's a management letter, whether if it's a internal control deficiency letter, whatever it may be, whatever escalation you need to go through, that we've appropriately captured that. This form, I highly encourage teams to fill it out as you go. It's very difficult to go back at the end and be like, oh, how many things did we find were wrong? Where did I find those deficiency errors? And I can't tell you how many times I've reviewed files where I've gone through and said, oh, on this work paper, we say we're going to write them up for a deficiency. And then I jump to this form and say, but it's not here. Where is it? It's because we thought about it, but we didn't execute it as it came up. So highly encourage teams, fill out this form while you're doing the audit so that things don't fall through the cracks. So some just general best practices for wrapping up the engagement. You want to make sure you're communicating misstatements quickly, timely, and making sure that everyone agrees upon them. You want to make sure that management knows. And again, no surprises across the board. No surprises within your engagement team. No surprises to the client. It's just a best practice to make sure we're all on the same page. We know exactly where we're going to land when we get to the conclusion of this audit. No one wants to find out. A partner doesn't want to find out, and a client doesn't want to find out that there's this significant error that we identified in AR testing, for example. Any judgmental differences, anything else like that, we want to make sure management understands, they agree with it. Any projected ones, we want to determine appropriate steps, make sure that all our testing is complete, and ensure that we've completed a complete package to address, again, those scales to make sure that, whatever our risks were, we've effectively addressed our procedures to address all of those risks, and any results of that have been effectively communicated. So as we are closing up for the day, we're going to go through and I encourage you again to write down any key takeaways throughout the day. We have a few more minutes. Feel free to ask any questions in the chat. The other thing we would love that you would all do is go ahead and fill out the evaluation. Sean sent out a note. If you go to this website, and you can copy it out of the note, the website, go ahead and fill out this evaluation.